Hello to all of you. Well, welcome to lovely to have you back. And sorry, I'm a bit late. My computer is playing games with me, and you won't believe it. One of the problems of COVID is that I've tried to buy a new Mac, and there are no 2 terabit Macs in South Africa. So I'm starting to learn the challenges with COVID and the impact it's having on our economy, which is what this is all about tonight. How to be financially resilient. And let me make sure that I am showing my screen. I'm not, so who is the presenter? Because I need to steal it back. Give me 2 seconds there. And where's it gone now? There we are. Share my screen. Okay. Let's just hope that everything's working here. So, Tommy, can you see my screen quickly? No, you're not seeing the screen yet?
No, not yet, Scott.
Give me 2 seconds. Lee, if you don't mind, would you mind just introducing everyone that's on that's joined us, and I'll just get this screen working. There's something wrong working here.
Yeah, sure. Good evening, everybody, and welcome to our webinar. We're really excited to have so many of you online with us and our panel. So just while Scott is getting that up and running, I wonder if you wouldn't mind in your chat box just popping in where you're joining us from tonight. We always like to know, firstly, to see where everyone's joining us from, and also to know that you are going to be able to chat with us during the webinar by asking your questions. So if you wouldn't mind popping that in while we say hello to our panel that has joined us. So firstly, I'd like to welcome Dr. Sohail Qureshi, who has joined us from the Intercare Group. How are you this evening, Doctor?
Hello, thank you very much, Dee, and everybody there. Thank you very much. Hello, greetings from London. Okay, thank you very much.
Then we have an incognito, because unfortunately the webcam on his computer is not working tonight. Andrew, welcome to our webinar. We're really grateful that you've made the time to join us tonight.
Hi, good evening, everybody from the darkness, but this is a very balmy Cape Town that I'm speaking from. We've had a very long summer, so winter doesn't seem to have come. So like Ken, who you'll be introduced to shortly, enjoying a very nice sort of late autumn, but looking forward to sharing some thoughts with you all tonight. Thanks, Lee.
Chad, one of our wealth partners, also from Cashbox, welcome tonight. We look forward to your insights.
Lee, thanks very much. Looking forward to chatting to everybody. Johannesburg's great. Looking forward to getting out of this lockdown sometime. And thanks for this opportunity.
Awesome. We have Hank, who is joining us from Taiwan. Hank is one of our partners in China. He's currently in lockdown, doing 14 days of self-quarantine before he can get out and socialize again. Hank, thank you for joining us. I know it is almost 2 o'clock in the morning there. We really do appreciate you looking bright-eyed and bushy-tailed for us.
Thank you, Lee. Thanks, everybody. Yeah, looking forward to share some insights and transformation about the markets in China. Look forward to the panel discussion. Thanks.
And then we have Ken Williams. Most of you online will know Ken. Welcome, Ken, all the way from the UK. You have been telling us about the great weather there recently.
Hello, everyone. Thanks very much, Lee. Great to be on a panel with the likes of Chad and Andrew again, and the 2 other gentlemen. We've had great weather in England, based down here in Tunbridge Wells in quarantine, and yeah, we've been fortunate enough that we are able to get outside and experience a bit of that. So nice to be here, and look forward to chatting.
Awesome. Thank you. And then I'm going to hand over to Scott now, but as always, I will be in the background making sure that the questions that you are posing are alerted to our panelists and we get as many of them answered. So please feel free to engage throughout the webinar, ask your questions, and let's have as much interaction as we can. So Scott, with that, I'd like to hand over to you.
Awesome, Lee. Thank you very much for your help. I really appreciate it. As I said, right at the beginning. I've been wanting to upgrade my Mac, and it seems to be playing some games with me tonight. So really appreciate you helping. Let's rock and roll right into the webinar tonight, which is how to be financially resilient in the current COVID-19 economic environment. Now, some would say we've never seen this before. Others would say that we are repeating what we've already seen. So let's rock and roll and get into it. You know, for me, it's really interesting. One of the commentators that I believe and like the most and trust the most is a guy called Ray Dalio. And he literally said the most important thing to do now is to diversify across countries, currencies, and assets. Now, I want to tell you a little story because it was actually in March, and it was just before lockdown, and some of us feel like that was months and months and months ago, where it was only 2 months ago, to be honest. And I was actually on stage. We were doing a roadshow, and I was on stage presenting, and Chad and Andrew and Ken, so Chad and Andrew from Cashbox and Ken from Migrate, and a guy by the name of Garth Wellman from Calio that again helps some of the wealthiest families in South Africa and America, and some of the property partners, Brendan Brown, some of you know, was sitting at the back. And you know what happens with presenters? We did a 4-day roadshow, and they get a bit bored. You know, after day 1, everyone kind of knows what the presentation is. And by day 3 or 4, these guys were more excited at the end of the presentation than they were at the beginning, and I couldn't quite understand it. And they were all excited to explain to me the discussion they'd had, and the whole discussion was, well, if we've got all these great products that are on the platform and we're sharing it with people, why don't we find a way to bring them all together and to provide a way for people to invest in a diversified product that would have multiple assets in multiple countries with multiple currencies? And it just brought me back to thinking of Ray Dalio, and I thought, wow. So, you know, really credit to a lot of the people that are actually on this call tonight already. It was an idea spawned 2 months ago. We've worked on it tirelessly to bring it together. And tonight is not a launch, but it's a Q&A with some of our partners to really understand their thinking, what's happening in the markets, what are the different asset classes, and how could a diversified opportunity assist you in achieving what you want to achieve for both you and your family in terms of your wealth. I did find it quite interesting. For those of you who know Henny Besaidnout, in the 13th minute of his webinar last night, he actually said that the number one thing that financial planners and family offices are looking for at the moment was diversification. So it seems that we are certainly onto the point of what people that understand money are looking at the moment. I think Lee's already been through this in terms of welcoming our guests. You know, Dr. Qureshi is a qualified psychologist in the UK, someone with 2 major business exits. So he's not just a doctor, but he's commercial, as he speaks about one of the most resilient asset classes in the UK, which continues to pay solid incomes. The second was Chad Pope, a serial entrepreneur who's figured out how to allow financial products, which were previously only available to the institutions and the ultra high net worth, to the rest of us, however, still getting the same relative returns. We've got Andrew Mobsby, who, you know, Andrew, I always find this one interesting, an advocate at the Supreme Court and an accountant, and who spent 27 years in the financial services and now runs a family office for 20 ultra high net worth families. We've got Hank Lin, who Lee's already introduced, from Taiwan, and is normally in Shanghai. That's what I was thinking with an S, is where I normally see him from, China, talking about what's happening in China, the rising middle class and the adoption of technology. And then Ken Williams, an investment banker of more than 20 years. And, you know, one of the things that I enjoyed was his conversations around black swan events and how it's changing the world, and you know, what you need to look at. So I'm going to bring the panel of experts up just now. And so please send through your questions. We're going to have as interactive session as possible. But before I do that, I want to set a bit of a scene. Now, these are questions I'd like you, I'm not going to ask you to actually put them up or answer them publicly, but I'd like you just to think about it. You know, are you economically resilient? Now, let's be frank. COVID was the pin that pricked the balloon. Everyone knew, every financial commentator was saying that there was a market correction coming, and COVID was just the pin that picked the balloon. So not only are you economically resilient now, but were you 3 months ago? Secondly, do you have diversified income streams, or are you reliant on one major income stream, maybe your business or maybe even a job? Are you diversified across countries, asset classes, and currencies? And I would add one more to Ray Dalio, partners. None of us want to have all our eggs in one basket. Are you feeling fear or uncertainty? I think we all are, and we just need to acknowledge that. And are you ready for what is coming? Now, I've got some good news for you. There's two things that are good news. The first is that history repeats itself, and the second is that you can copy successful other investors. So the good news is that whether we like it or not, we were on a discussion just this morning, and myself and one of my business partners, Richard Dunn, was talking about the global financial crisis, and we were talking about how market commentators said the world was falling apart and how currency was going to disappear and how we were all going to be in absolute economic collapse. And him and I were reminiscing how that was the same conversation we had 12 years ago. And so history does repeat itself. And secondly, one of the fastest ways to success is to copy what other successful people are doing. So it's pretty common sense. We're entering a recession. And what can we learn from the last couple? Well, in 1929, it was all about panic and loss and, all the money that was lost. And you've seen the crashes, and many, many people didn't have jobs. I grew up with my grandparents telling me how they all had no food and no jobs. And this one probably sums it up a little bit. Why can't you give my dad a job? But actually, if you look at the facts of what happened in that time, America, more than 50% of the banks failed. There was 25% unemployment. The stock market lost 80%. Housing prices lost 67%. International trade collapsed 65%. Deflation soared above 10%. It took 25 years for the stock market to recover. And some thought it was the end of the American dream. And yet there was a guy called Joe Kennedy. Some of you might have heard of him because his son, JFK, went on to be president. And in that same time, he grew a wealth of $176 million, or 45 times his wealth in that exact same period. And so what did he do different? What can we learn from him? Well, the first is that he possessed a passion for facts. What are we looking at tonight? Information and facts. Secondly, a lack of sentiment. And thirdly, a sense of timing. And the fourth thing is that he invested heavily in real estate. So assets with intrinsic value, and you can see the fortune that he made there in terms of his actual numbers today, in that same period where most of our grandparents told us about how terrible it actually was. There was the crash in 72, the oil crisis. There was 87, Black Friday. There was 2001, .com, 9/11. And in 2008, we had the GFC. And now we have the Corona crash. And so what do we know? Well, the first thing is that the WTO, Robert, I can't pronounce this name, Azevedo, predicted a drop in global trade greater than the Great Depression, saying this may well be the deepest economic recession or downturn of our lives. The global financial crisis, the GFC in America, 8.8 million jobs were lost in 4 years. And now in just April, 22 million jobs were lost in America, and they're now over 30 million jobs. The GFC, they wiped out $19.2 trillion worth of household value in 4 years. And in just April last month, they wiped out $9 trillion. In the GFC, which was 12 years ago, the first world really suffered, but the emerging economies grew aggressively. And yet Corona is global. It's affecting every single one of us, every business, institution, and government. In April in 2020, 31% of residential tenants in America didn't pay their rent. 85% of retail tenants didn't pay their rent. The UK economy is expected to shrink 35%, and unemployment in Australia is over 10%. And what's interesting this time is that first world economies are pumping massive stimulus into their economy, and yet the emerging economies just don't have the resources. The stock markets are taking a beating. Real estate, crypto, and other assets are losing value. And the challenging thing for us as investors is we sit back and we say, well, what does this all mean to our income streams? And there's a lot of uncertainty. So where do we go from here? Well, I want to set a little bit of a precedent, and then I want to hand to our authorities. There's 8 things that we can learn from the most successful investors of our time, and I believe that we can copy them. The first is Warren Buffett, and he says, don't lose capital. Wealth protection is critically important. The second is focus on income generating assets. There's a reason that Warren Buffett is the largest investor in Coca-Cola, because it provides the best income distributions that you can pretty much get out of the stock market, and it's distributed across 200 different countries. Jim Rogers says, don't panic and focus on where the world is going to. I had the privilege of having lunch with him twice in 2014 and 2015. And he said to me, the world is shifting. It shifted from England, it shifted to America, and now it's shifted to China. You've got to focus on where the world is going. Jeff Bezos invest for the long term, solve customer problems. Just on those two bases, he built Amazon into the most valuable company in the world. And recently, in the last couple of weeks, was actually called a better investor than Warren Buffett. And finally, invest heavily in downturns. He's just told all his shareholders that he'll be investing their entire profit, $4 billion, to shred their competitors and take market advantage during this time. And then finally, Ray Dalio. We've already spoken about him, but his number one thing is diversification. Diversify across assets, diversify within assets, diversify across markets and currencies, diversify across time, and diversify across partners. And there's a beautiful little quote that I found where he's basically said, to be wealthy, all you need is 15 uncorrelated bets in an array of attractive assets that don't move in tandem, reduce the risk by 80%, and the risk return ratio increases by a factor of 5. So if you've got no idea of what he is talking about, then you'll need to come to one of our other webinars where I discuss that in more detail. So what I wanted to share with you now was just a very quick little video, and I hope the sound will work for you. With literally, Ray Dalio was on a TED Talk now in April. It's like a 50-60 minute TED Talk, and I've literally cut out the most important part, which I want to play for you. So I'm going to take my headset out so you can hear it clearly. Just give me 2 seconds.
First of all, an investor must understand that they probably will not be able to play the game well. What the individual investor needs to do is know how to diversify well. So the word that I would know how to diversify well and in a balanced way, and to know how to diversify it in asset classes, to diversify it in countries, to diversify it in currencies, to know how to diversify that well so that you have wealth diversification is important. Do not think that cash is a safe investment. I can't get into all the different ways that one can diversify well, but I would say diversify well, be humble, don't market time, and be conscious of the dangers of cash.
I love that little quote, and if you want to send the full video, I'm sure Lee can find it for you and put it in the chat box, or just Google Ray Dalio TED Talk 2020. Now, what's quite important is that Ray Dalio runs the largest hedge fund in the world. It's worth $160 billion. About 10 years ago, you could only get into it if you had $100 million cash to give him. And so he's clearly one of the more respected people around the world, and his company is Bridgewater. The problem is that if you don't have $100 million, what do you do? How do you do it? Who do you do it? Where do you invest? And when do you invest? And that is why we're excited tonight to be sharing with you the wealth diversification portfolio. Now, we're going to go into a Q&A now with our authorities, and I will share when we're done asking all the questions, I'm going to share with you an opportunity of how you can participate and you can invest, taking all of Ray Dalio's principles, Warren Buffett's principles, Jeff Bezos's principles, and Jim Rogers' principles, and you can invest simply and safely using technology. And so I introduced the panel already. I think you all understand who they are, and hopefully it's given you a little bit of context around why we're here and what we are actually trying to do. I do know that Bhavan, the CFO of Intercare, has also joined Dr. Qureshi, just in case there's operational conversations that I know we can't see him on the screen, but he is here in case there's any conversations that Dr. Qureshi would like to hand to him. And so, Dr. Qureshi, I'd like to start with you, if you don't mind. And just for all the panelists, I'm going to run through the order that I introduced you in. And we had a fascinating webinar with you about 2 or 3 weeks ago. And I took this quote from something you said when we did the webinar, which you spoke about the aged care industry and how it's one of the most highly regulated industries in the UK. I loved what you said around there's a moral authority of society to look after their aged care, and that 85% of the income is paid by the government. But before we get into that detail, would you mind just explaining, you are a qualified doctor, you're actually a psychiatrist, as I said, what is your experience in terms of firstly the medical space, the whole sort of medical, what do you call it, faculty, and then equally this sector of aged care, you know, where it is, you know, based on this whole COVID-19, and more importantly, where you see it going.
Okay, thank you. Thank you very much, Scott. Thank you for having me here again. I'm a medical doctor. I have a number of years of working in medicine and surgery, and I said including working in South Africa as well. I retrained to be...
I did forgot to mention that, exactly. For those South Africans, he's actually got South African citizenship. He lived in Durban for many years.
Yeah. And now for almost 18, 19 years, I'm here in the United Kingdom, living in London primarily. And I retrained to be a psychiatrist, and I've been working as a consultant psychiatrist, which is really top of the tree in the clinical kind of forestry. And alongside, I have also been working with a number of organizations in a more strategic, medical, and operational. So I can proudly say that I understand the medical, surgical, health issues, as well as psychiatric and the social care needs. There is about 500,000 people in this country who need elderly care in the care homes. There are about 11,000 care homes in the country, and about similar kind of number of people with elderly needs. They are looked after in their own homes through domiciliary care or supported living. So there's a huge market there. It has been a growing market. It has been a stable market. The funding of this market is primarily by the government, and there are different buckets of that. They're called local authority, social services, continuing health care, NHS, and different CCGs or clinical commissioning groups. There are some kind of a top-ups. Say, for example, a particular gentleman, he is measured to be sponsored by the government for, say, for example, £800, but the fee of a particular care home is £1,000. So then this person or his family or her family, they decide to top it up. So that is why when we say that 85% of our income, or actually more than that, is coming from the stable sources of the governmental treasury, so that is true. Okay.
I'm so unused to having to mute myself and unmute myself. I was talking away there. So I've got the notes, Dr. Qureshi, from the last time, you know, and if people do want to watch the full webinar, they can certainly get hold of it. You know, just in terms of the aged care and COVID at the moment, you know, many of the deaths have been traditionally in elderly people. And, you know, how has it been affecting aged care? And equally, where you spoke about it being highly regulated, and you're obviously a qualified doctor, as you've already explained. What is the difference between the impact it's having on the aged care, you know, investment area, if you want to call it that, and secondly, from a government perspective, when you say it's highly regulated, what does that mean, and what are they expecting from the operators to ensure that they're looking after the elderly?
Right. Okay. All of healthcare sector is regulated by the government through a very powerful independent platform or board, which is called Care Quality Commission, CQC. And anybody can go there on the website cqc.org, and they basically measure that each and every care facility where the medical care is provided and social care is provided, they are according to a set standards. So they have different ways of measuring them, basically 5 domains that they measure. And then according to that, they provide a yearly or 2-yearly reports. It's a very thorough assessment. Basically, they look into the staffing, the safeguarding issues for the patients are being looked after, and if they are well led, if any and everything that a person needs in a care home or a hospital, they are according to the top sterling quality. And that is what I meant regulated. Anything that you do, if you are culpable, if you have done anything wrong as a service provider, you could be actually charged for corporate manslaughter. So there's a full force of a law that is behind that. That ensures that every citizen and every person or patient needs are met with fully. So that is what I basically mean highly regulated. So that is just one area. Then there is the NHS, which is the National Health Services. They have their own internal monitoring systems. Then we have a social services. They have their own monitoring system. So basically, any day-to-day, weekly, monthly, yearly reporting, there is a systems and processes that organizations are held responsible. There's a concept we call clinical governance, which basically ensures that all organizations, they are accountable how they perform in front of the public and the regulatory authorities and the funders, as well as patients or residents and their families. And that is why we have seen that the newer regulations are coming in, and to ensure standardization and also to improve the quality of the service. So that is where the highly regulated part comes. Now, second part of the question that you asked me is about the COVID. Yes, it has actually, COVID definitely has a propensity to hit the elderly population. The evidence so far suggests that there are probably more than 60 to 70% of the people over the age of 60, they succumb to this unfortunate deadly virus. People in the care homes, they are particularly susceptible to. The general understanding at this time, as it is an evolving situation, that probably people will lose in their care homes between 10 to 20% of their patient population. So that is a fact. However, in terms of, and I'm just trying to put my corporate hat there, in terms of the business, yes, that is unfortunate. However, as a business model, we work on the margins. So if you lose an X amount of your patients or service users, similarly, your expenses are going to go down as well. So all of those services which are working on a very stable staff, they are efficient in their working. So even though they may lose patients, so accordingly, and actually almost in the linear correlation wise, they will have less expenses. So the margin will remain more or less the same, which is, as I said before in my last webinar, they ideally hang between 25 to 30% of EBITDA of their the volume of revenue we have. So thirdly, how we are coping or how we will cope further, we have a very robust clinical team, and that distincts us from others, because obviously being a doctor myself and having quite a good reputation of my clinical practice, as well as the team that I have collected, we are very strong in providing a very safe, quality clinical service. And part of that is efficient ways of working, a smart, intelligent ways of working. That means reducing costs. So our margins, they stay more or less the same. The good thing is that we are actually now started making our name with the local services, and they are actually referring us more patients than we actually had before, even though during this COVID period. And we are actually able to pick and choose which one we would like to have in terms of our productivity and profitability. So we feel that people like us, and especially Intercare, we will be the leading organization really ahead of the curve, because we have invested heavily in our clinical services, because at the end of the day, it's a business and we sell a product, and our product is a clinical product that we deliver in a very safe and a professional manner.
So thank you very much, Dr. Qureshi, and I'll come back later, to get more into the product and the investment. My last comment, though, which I think is really important, is that, as you say, it's a highly regulated industry. 500,000 people live in care homes. There's about 11,000 care homes in the UK. And what's interesting is that 80% of those are family owned and operated, and only 20% of them are institutionalized with 5 big sort of corporate companies that are running it. And So actually in these tough times when you've got these challenges, plus you've got the regulation, it's teams like yours that have the corporate commercial approach with all the right sort of medical degrees and understanding that really it actually adds to the advantage. And it's the mom and pop operations that are really struggling, which we'll get into where you see the industry going in the next question in the next 5 to 10 years. But that certainly is something that I just wanted to highlight for people to understand, that sometimes a negative can actually play into be a positive from an investment perspective. So
yes.
Sorry, I'm struggling a little bit with the timing, but I want to just any final comments just around the overall industry from your side, Dr. Qureshi, or can I move on?
I think there is definitely a bit of a jolt. I think what it will do, it will actually kind of bring an inequilibrium, and that will shun off all of those care homes or residential homes or nursing homes which were not performing well, or which were not very well led, especially clinically, and they were not efficient and productive. I think they will suffer, and those which are very robust, which really go to the minute and minor details of functioning, they will consolidate and they will benefit far more than the jolt that we have. Also, there is a general awakening in the United Kingdom and all over the world, because the way the government actually appeared not to make enough preventive and preemptive measures, that there will be lots of funding coming in. We already have received COVID loans, COVID grants in the care sector. So the social services and governments are, helping them a lot. Also, they are also thinking of increasing the weekly and monthly and yearly fee structure. So that will also help. But again, as I said, that those fittest of the fit survive, that we'll have to bring the Darwinian hypothesis here. And I think that we are very well placed to really take this challenge and convert it into opportunity.
Excellent. Well, thank you very much for your expertise in the space. And as I said, we'll get into the exact details a little bit later. I'd like to pivot to Chad Pope. I've known Chad for a long time, more than 11 years now. And as this comment here from Chad was, he's been in business for a long time. He likes to make his money in business and ultimately invest in property. 5 years ago, he wanted to try and find something as reliable as commercial property for passive income. And dealing with family offices. So family offices again work with high net worth families. He found structured notes. If you haven't heard of a structured note, don't worry. 12 months ago I hadn't either. And he's going to explain what it is to us. But it's a sophisticated way to invest in the stock market. And now using technology, you can actually get the same relative returns as institutional investors. And so you can see that Chad put up here an invitation for us. Chad, talk to us a little bit, if you don't mind, about your journey as an entrepreneur and property investor. Why is your obsession around predictable income? It's so interesting. Middle-class people are always chasing capital growth, whether it's trying to buy a house because the price is going to go up, or trying to buy a stock in the stock market because the stock's going to go up, or even, I got another one just this evening, should I invest in cryptocurrency? But it's all about capital growth, whereas, sophisticated investors tend to focus on income, and not just income, but predictable income. And then finally, why did you want to diversify? If property was working for you, why did you go looking for other things? So talk to us a little bit. I know it's a couple of questions there, but talk to us about that journey.
Yeah, cool. Scott, thanks very much. And great to be here. The opportunity is awesome, and it's really my purpose now to try and share this stuff. So again, thanks for the platform. I'm blessed. My wife and I make a great team. I studied mechanical engineering after school, and my wife's an auditor. And when we got engaged, we went out and bought a house together. And I was looking forward to living in Sin for the first year before we got married. And the estate agent said, "Hey, listen, I got a tenant who's desperate for a house. Are you happy we do a deal?" And we got way above market rates. So that blew my idea. My wife was excited because we could make some money. And at the end of the year, when the tenant moved out, we had a pot of money to go and do something with, and we went to go and buy some furniture and some fittings. And the realization hit me, well, you know, what if I had 4 or 5 of these properties? Maybe I wouldn't have to go to work. And if we had 10, maybe my wife wouldn't have to work. And that started driving this obsession for passive income. And being a mechanical engineer, try to work the system, try to understand how this would all work. So my wife and I then started a property. Sorry about feedback there. We started a property portfolio, and then soon realized, oh gosh, maybe as good South Africans, we should start looking at investing offshore. And that's where we met you, Scott, about 10 years ago. And I went back this evening to have a look. We invested at 7 Rand to the dollar at that time. And really grateful we got started with that opportunity. So working with property rental, I figured out, well, hey, my love for mechanical stuff, what about equipment rental? And that started a whole new business. But my warning to everybody, if you go into equipment rental, you're going to go gray like me real fast. It's a 26-hour operation. But what we kept doing is kept channeling money from the business back into properties. And about 5 years ago, I got to meet Andrew, who you'll be introduced to just now. And I said to him, I'm desperate to find something to run in parallel. I love property, local and offshore, but how do we go and find something else that's predictable? Because folks, you know, if we've got multiple streams of income and they are predictable, well, I can plan and maybe I can go do something else with my time. And I'm blessed, my wife's blessed. We're in that position now where we can make choices because we've got steady streams of income and we've got them from different sources. I'll always have property, I love it. And along came this opportunity of structured notes. And as Ray Dalio says, it gives us an opportunity to diversify. As we do with property and the Wealth Migrate opportunity, we've diversified across structured notes. I'll chat a little bit later on that, but they are bank guaranteed, predictable income contracts. And when I got to see this, we approached Scott about a year ago and said, Scott, we got a great opportunity to put something in parallel because I am desperate to show my kids how to invest at an institutional, not a retail level. How do you get real returns and how do you protect yourself? Don't invest unprotected.
Interesting you say that, Chad, because, you know, when you approached me a year ago, and it's one of my biggest frustrations with the industry as a whole, is that, you know, arguably I've been to school, I've got all the degrees, and yet, you know, you mentioned a structured note, and I'd never even heard of it. And then, you know, when you said, well, let's go out to our top 100 investors and let them know about it, I was waiting to have a whole bunch of, is the right word, vitriol, whatever, where like they come back and it's rubbish and this and that. And I couldn't believe how many wealthy people came back and went, yeah, no, we all invested in them already. Every single person that had a family office was like, no, we already all invested in them. And I think it's such a good lesson for all of us. It's like, well, you know, okay, hang on, you know, we're not even on the same playing field, and yet we want to get the same results, you know. So it was a big learning lesson for me in the last 12 months. And I think it's quite a good interlude in terms of to bring up our next guest, which is Andrew. And you know, Andrew runs a family office. I said to you, it's quite a unique combination of a lawyer and accountant and someone that's playing in the financial services space. But for me, Andrew, you know, you deal with a family office actually helps the most wealthy people in the world. So the wealthiest people in the world, they have a family office, and it's someone that looks after all their financial affairs. And you know, most people are just out there trying to create wealth. And yet when people are wealthy, it's not only about wealth creation, but it's also about wealth protection, wealth preservation, a plan B. You know, how valuable is peace of mind? You know, when Chad says him and his wife are lucky, you know, you can't put a price on that, but what that value of peace of mind, and then generational wealth. And you know, for you, Andrew, you're out there all the time. You're helping you help 20 wealthy families at the moment. Why are people firstly so resolute on wealth protection and wealth preservation? And what is it about balancing portfolios so that they can achieve these type of things like Plan B, peace of mind, generational wealth, etc.? What has been your experience? 27 years in this space.
Thanks very much, Scott, and good evening, everybody. I think, like Chad, financial services and banking is sometimes a bit of a toxic mixture for my hairstyle, and I'm equally grey, so although only 59 years old. So
what are you
yeah.
saying?
So I think I'd like to start this, and it's a question everybody can internalize and think to themselves. I'm not looking for answers. The question I often ask of the high net worth families that I represent is I ask them a question: what is wealth? In other words, I ask them to define wealth, their understanding of wealth. Inevitably, the definitions that come back are very personal relative to their particular journey. And usually it revolves around the value of their assets and their balance sheets, and actually more recently, their health and the status of health being wealth. I use a different measure of wealth. I'm not to say it's the right measure, but take an angle on this. So it's not my definition, but I've adopted it, is wealth is what you have when you've lost all your money. Okay, wealth is what you have when you've lost all your money. That's quite a statement to say to an individual or a family who's got multiple noughts on a balance sheet. And sometimes they don't think about it. And it's a fairly contrarian view coming from a point of being bankrupt or having no money. But in reality, I think it's very true. It's about the people who will be there for you, who will support and nurture you, get you through that tough time. You know, it's the value of the people that you are going to surround yourself by choice with. So that's my little definition of wealth, just internalize. Okay, that said, what we all do as humans, we strive to accumulate and thereafter to preserve. It's a natural attribute, specifically of monetary value. It's clear that if you really look at the old money, in inverted commas, if I can use that, as in the European sense, you know, money that goes back perhaps centuries, in that sense of the descriptor, that money is intergenerational. We should have a sense of respect that we are custodians of our wealth for our children and for their future generations. You know, hence the inordinate focus on preservation. There are so many wealthy European families whose money has been simply preserved and grows through ups and downs, through civil wars, through plagues, through COVIDs. Yes, it goes up, but it goes down, but it's preservation that is key. Scott did mention earlier, and it is a trait that you pick up in many wealthy families and successful people. Income is more important than growth because it becomes predictable in cash flow, expenditure, a whole range of things, but we can talk about that later. So actually, irrespective of quantum, let's not talk about the high net worth families, but they do always diversify. It's absolutely key. It's a golden thread that runs through every single one of their carpets, if I can use that analogy. And even if their main wealth or income stream stems from a particular business or endeavor, they will always make sure to diversify, risk off and get risk away from their positions. And they generally do it for two reasons. They mitigate economic and financial risk and political risk. So for those South Africans that are on the call tonight, we're all very aware of the twin endemic, you know, features that face us on a daily basis: economic and political risk, and how it affects our state of mind, our balance sheets, and everything around us. To not diversify is really going to ground zero, because the opportunity are all there. You know, with the opportunities to invest in different economies, different currencies, in uncorrelated geographic areas, the world is suddenly a very, very small place. And you know, when I was first introduced to Scott, also a few years ago, the use of smart technology has simply made that within the realm and the reach of the ordinary man in the street. And I don't say that I say that with absolute respect. Everybody can reach out into spaces that hitherto, or in past years, were the preserve of the wealthy, were the preserve of the ultra high net worth. So smart technology, I believe, is absolutely fantastic. It goes cross-border. It can go anywhere. It's relevant. It's changing. You've got to keep abreast of that. So balance equates to diversification. I was asked that question today. What does it actually mean? I said it equates to diversification. It's all about the appetite for risk. Okay. At the wrong end of that scale of risk, in many instances, is greed. I might not be in the same realm as Warren Buffett, but I believe never be greedy. Yeah, his famous mantra was be greedy when others are fearful and be fearful when others are greedy. I think there's a middle line there. I don't think you need to follow that mantra with complete blindness. So wealthy families, and in fact all investors in short, must look to manage their assets dynamically, and what they do the families should love. You should love predictability in your life. You should love protection, and you should love to create wealth if it's financial wealth through the opportunities. And this is where it's very important. The wealthy families make money in downward markets, in sideways, and in upward markets. So believe you me, there's money being made right now. At this moment, since March, when we saw the massive corrections, it's being made all the time. It's just that it needs to be made in a clever, smart, tech-savvy way. And guess what? The vehicles that they have been using that Chad wasn't aware of, they are now becoming increasingly available to the more retail type of, at a more retail distribution level. And I really, really urge you to explore the opportunities that Ken and Chad and Scott will be talking about the blended portfolio. You know, as Scott said, we are heading into a recession or a greater depression than 2001 or the last decade with the great financial crisis. The words market attrition, crash, correction, negative interest, negative equity, these are words we don't want to hear. We haven't been used to these for 10, 15 years, and they need to be weatherproofed, absolutely. So in summing this up, I'll give you the following words that I've heard. Well, let me rephrase this. The sort of following words I'll share with you are generally words uttered by families entrusting wealth. I've heard them now through the times we're going through currently, and I've heard them 20 odd years ago. And I just paraphrase, I actually wrote it down because I hear it all the time. The instruction is balance my portfolio through diversification. Provide me certainty, provide me protection, and provide me predictability. That is core. We can sprinkle some exotic stuff around it, but do not mess with the core. So that's essentially the focus that we have to bring to these families.
Certainty,
Scott?
protection, and income.
Yeah.
Perfect. That's excellent. Well, thank you very much for that. I love these webinars because I always take notes, and I think I learn more than anyone. So it's my privilege to be the person asking the questions. I wanted to pivot because you spoke about smart technology, and I was invited to speak at South by Southwest about 2 or 3 years ago, and the Americans are always so excited about all the big changes they're having and artificial intelligence and all these fancy words. And yet I've had the privilege of going to China now on business since 2015, and it just blew me away what was happening on the ground there. And Hank's joining us, and I just want to point some of the stats that are here. In 2006, 1% of Chinese people had a mobile phone. Today it's more than 50%. There's over 1 billion users a month on WeChat. Their phones are literally part of their lives. They don't have cash anymore. I mean, this just blows me away. 42% of the world's total spend in e-commerce is from China, and that's more than France, Germany, England, and America put together. So anyone in France, Germany, England, or America think you're important, you're smaller than China combined. That's why there's so much money flowing to China. It's why there's more millionaires being created there. And what's so interesting is that they're moving through this evolution of using their phone, communicating with your phone, catching the taxi, paying for lunch, and even starting to invest. Hank, you're on the ground and have been on the ground. One of the things that I struggled with in the beginning was to I don't speak Mandarin, and to be able to deal with people locally and understand each other. But you were educated in America. You're from Taiwan, which we won't get into a political debate as to whether Taiwan is or isn't part of China. And but most importantly, you truly have witnessed it your whole life. You've seen the rise of the middle class. You've seen the adoption of mobile phones. You've seen this e-commerce and online adoption. Give us your perspective of what's happening on the ground. We can all see the stats in front of us, but what does it actually mean to someone living? I know you're in Taiwan right now, but someone who actually lives in Shanghai.
Right. Hi, Scott. Hi, everybody. So just a quick background about myself. Like Scott was saying, I was born and raised in Taiwan, but really moved to America, Los Angeles to be specific, when I grew up. So I pretty much spent like 2 decades studying and working in the US. And what really brought me back to China was in 2008 when the financial crisis hit. And then so it was really tough and difficult time then. And I figured I had family in Taiwan, and then noticed that China was one of the few countries that didn't really, that was really sheltered from that crisis. And then so, and I was very fortunate to find an opportunity, and I work as a supply chain operational consultant starting in 2010. So I moved to China and work and live in China over a decade ago. And I really witnessed the change and transformation over the last 10 years. And like Scott was saying, what really changed and transformed China is really, I think there are three things. First is the adoption of smartphones, to be specific. I think in 2010, people were still, not many people with smartphones around. I think iPhone didn't really hit China until it was the fourth generation. So, and so through that time, you know, and from 2010 to 2015, it was kind of business as usual. People go to the mall to buy stuff. I think the e-commerce numbers weren't really that big yet. But the second thing, what really changed was the government's policy. I think in 2015, the government really encouraged the Chinese people to innovate and entrepreneurship. So that's when the time a lot of money was flowing into China, and there's a lot of innovations, like different various platforms are beginning to forming. And then the third thing, that what really changed, like you said, is the rise of the middle class. And then what really changed, what really drove that is the rise of the property values. And I just kind of want to give you an example of my colleague, Ken Hu. So he purchased like a 90 square meter apartment back in 2004 for 70,000 USD. And I believe he sold it 2 to 3 years ago for nearly $1 million. And then I think it's because the rise of that value, and that really changed the landscape and then the middle class. So now when you go, like you said, Scott, when you go out, you can only just carry your smartphone and do everything on the phone.
Dr. Qureshi, sorry, could you just unmute yourself?
And so I can't really remember when was the last time I brought wallet and used cash on it. So, and then what really changed the landscape now is, like you said, nobody really buys items from mall anymore. So a lot of the new and shopping malls, you can see the percentage, the food and beverage shops are nearly 50 or 60%. So before it was probably 20% because there's a lot of people still buying clothes from the malls, but now everything's really transformed and changed online. So that's really the change, and that's where the opportunity is in China.
Awesome, Hank. Well, thanks so much for that. And, you know, one of the reasons that I'm very grateful that it's 2 a.m. or 3 a.m. in the morning and you're sharing with us is that I think China gives us a window into where the world's going. You know, Corona, no Corona, there's online adoption. It's already happened in China, and the rest of the world is actually playing catch up. And, you know, what's interesting is that Corona is forcing that online adoption. And so as investors, whether we're looking at the stock market, whether we're looking at property or any other asset, we need to look at what that adoption means. You know, if you're buying into a retail shopping center right now, you seriously have to wonder where the world's going, you know, in terms of what's happening. And I can understand why Chinese people love property when you consider that $70,000 to $1 million is about 1,500% growth in 16 years, to put it in perspective. Right. So pivoting to you, Ken, and you've been very quiet there, and you know, it's you're in London and summer's on its way. Now, from your perspective, you know, you're an investment banker. I know we did the roadshow in March, and we spoke about black swans and, you know, the impact of them and what's happening in markets, et cetera, et cetera. But what's also been interesting is I've had a number of conversations with yourself, and I've heard you talking with others around how in these times, you know, some people are running for safety and others like Jeff Bezos are running towards opportunity. and where that diversity comes in, and where those opportunities find themselves. And as an investment banker, you know, and someone who actually owns quite a large property portfolio yourself, you know, why were you intrigued around the whole sort of fintech space and what's happening in the space? You know, what is your journey, and why is fintech exciting, and what do you think is happening with Corona in the space? Ken, you muted, I think. Can we just check? Can the rest of you hear Ken? I can't hear him.
No, he's muted.
Well, he is muted. Ken, you're just going to need to unmute yourself. Let me see if I can try and mute you there. Stop. Where's he gone? It says you unmuted. There they are. Try again now, Ken. That is so bizarre. We were talking to you just now, and now you disappeared. I tell you what, Ken, I think I might, let me come back to you. It might be worth you just disconnecting and reconnecting, because there seems to be something wrong with the sound. I'll come back to that question for you, if you don't mind just joining us again. So it's quite interesting, you know, a lot of people talk about where the world's going and what we should do, and it was shared by Sam Zell. So Sam Zell is he's a billionaire. He's one of the oldest property and most recognized property investors in America. And what was really interesting is that Brendan Brown actually shared something. You know, one of the things I love about being a wealth partner and being part of our inner circle is that you just get the most amazing content shared with you. And this was shared about a week or two ago on the overall property markets, real estate markets in America, and where the opportunities were. Ken, I can see you coming. Are you back there?
I'm back. Can you hear me, Scott?
Yeah, we got you loud and clear.
Can
Okay.
everyone hear me? That's
I'm going to.
That's the weirdest.
That's
the weirdest.
You got to love technology. So before I go to Sam Zell, let's go back to Ken Williams, live from London.
You know, this is what I was going to say. I was going to start with, you know, I was going to start with my background as an African, and I moved into England 20 years ago as an investment banker. But we're really talking about first world assets here, and I was just going to say it's interesting that the technological problem this evening has happened in the first world. One of the first world assets that we're presenting. I had 20 years as an investment banker. I was in stockbroking, and I did I sort of moved through corporate finance, equity capital markets, and ran a stock brokerage in the CEMEA space, Central Europe, Middle East, and Africa. I raised just under $8 billion over that period across about 85 plus transactions, and I have a love for property, so I have a property portfolio down in the southeast, and I was introduced to Scott, and it just started to become very apparent to me that I really needed to start looking at fintech, and it's really been a move with huge regulation in markets and the change in global markets and global securities as to you know, you're finding quite a lot of bankers moving into this sort of space. Presents us with a huge opportunity, and you know, basically what we're doing here is from our you know, from our screens at the swipe of a finger, we're able to invest in properties. We're able to transverse the globe at a you know, at incredible pace. Without the need for opening of bank accounts and you know, for a huge analysis on the markets that we're in. So it presents a huge opportunity for us.
Ken, tell me, you know, we had an interesting conversation because, as I said to you, I was on stage, so I wasn't even part of this, and yourself and the guys at Calio and Chad and Andrew and some of the property guys were talking about building this, you know, diversified opportunity. And with structured notes, with property, and one of the things that actually Callio started talking about to start off with was private equity, and why private equity was so important as a piece of the balanced portfolio for their high net worths. Talk to us a little bit about that, because you had a strong argument with a CEO yesterday who said, people shouldn't be investing in private equity, they don't understand it, etc. What is private equity, and why do people look at it in a balanced portfolio?
Yeah, I was actually surprised yesterday. I had a call from someone, and it appeared that he's a fairly affluent individual, and it appeared that it hadn't dawned on him that you could in fact purchase a mix of assets via a diversified product, just like it exists in a diversified portfolio, like Andrew described earlier. And what does that mean exactly? Well, you mentioned Callio. The individual that runs that company is a guy called Garth Wellman. He runs a family office just like Andrew Mobsby here. And we all shared the panel in South Africa along with Chad Pope just before the COVID lockdown, and we all thoroughly enjoyed ourselves. It was interesting that Callio, while they are investing across the spectrum of assets, they actually look at investing in private companies, but they've gone a step further and they've actually launched a private equity fund for this purpose. So, why do private companies issue shares or loans to investors? Well, specifically, they do that for the purpose of growing their own businesses. In doing so, their investors benefit in sympathy or simultaneously with them. So, this concept was lost on my friend, and it represents a key opportunity out there, particularly in this time when you can actually find distressed assets. You can find, properties where the developers have been less fortunate, possibly actually need to exit those properties for one or other reason, and you're able to pick up distressed assets. So it's a case of looking across asset class. The big thing to understand with private equity is that we're in a circumstance like this. We look globally, and we first, when you get a crisis, and Andrew was talking about risk off, for example, the first thing you'll do is you'll look to public assets in developed economies. Then you will look, and of those assets, you'll look to government debt, for example, as a safe haven. When that's full and that's discounted, so in other words, it's been bought up, it's no longer cheap to get into assets like that, well, then you will look at maybe the top emerging markets, and you look at their asset class in debt. Simultaneously, you might look at equities in developed markets, and the same thing, when those equities start looking expensive, you may look at emerging markets. Now that's on the public space. When you look then privately, well, you can look at all those asset classes from a private perspective, and into private companies and into securities that those private companies might be offering. For example, like equity in their business, or like debt offerings in their business. And therein lies the opportunity.
Brilliant, thanks, Ken. I look forward to coming back and talking about that a little bit more later. So I for some reason I've got to take my headset out so that you guys can hear. So thank you very much, Ken. And I want to pivot back to what I was talking about just as we were waiting for you to join. And I was talking about billionaire Sam Zell. And again, if you don't have the full report, I would highly recommend listening to it, because he talks about retail, he talks about multifamily, he talks about industrial, etc., office space, where he's just talking about one of the niche sectors. And I think one of the important things in any investment is that you can't say property's going up or down, you can't say real estate's going up or down, you've got to get niche. And this is
we also own a hospital chain. The hospital chain is located all over the country, and in a lot of places the impact is almost unfelt, other than the fact that the government either locally or at the state level stopped us from doing elective surgery, which is a very high margin business for hospitals. So it basically subsidizes a lot of the other parts of hospitals. On the other hand, we have one facility in New Jersey where, it's wild. I mean, it's, and by the way, I think the government, as it relates to hospitals, has done a great job of anticipating how to avoid liquidity crisis and how to, in effect, maintain that the hospital exists. So that's another side of the coin.
I'd really recommend you listening to that whole interview and just the different sectors. And, for the purpose of tonight, we don't have enough time to go into all the different sectors. One of the things that we are looking to do in terms of the wealth diversified portfolio is to ensure that we've got a niche commercial opportunity. There's 3 partners that we are dealing with at the moment. One of them is a $14 billion company. They've got 1,300 staff across America, England, and Europe. And as you can see, they're in every different facet, from student, residential, senior living, office, international, and industrial. And we're actually talking to them about bringing on a highly niche quality opportunity with at least an 8% cash on cash. And really for us, it's looking at that, the quality of that partner and that niche opportunity. We are talking to another partner who's got a listed tenant. Our investment committee, had some questions around that because, listed tenants are great, but Lehman's was also listed. And unfortunately, when Lehman's went bankrupt, the landlord thought they had it covered until AIG nearly went bankrupt in the last crash. So, one of the things that when we created the investment committee back in 2013, one of the many things we put in for the investment committee was to make sure multi-tenanted, multi-income streams. The next thing for us is we want to look at multiple assets, multiple countries, and also diversify within assets. And Dr. Qureshi is here, and as I said to you, he has been joined by Bhavan, his CFO. And I'd love to know, Dr. Qureshi, with regards to Intercare and specifically the medical aged care facilities, you guys have a unique model, and not only in terms of when you invest the properties, the way you buy it. They often say in property, it's the value is created when you buy the asset. Talk to us a little bit about your model at Intercare and specifically the opportunity of investing in one of your aged care facilities.
Yeah, thank you very much. And I must say thank you very much, other panelists. It has expanded my knowledge of different sectors. Thank you very much. Very powerful statement that you made. Yeah, this is a very unique kind of investment opportunity here, because this is something very tangible. It's a property-based, asset-based, so there's a touch and feel kind of element there. So that is number one. Number two, the client group that we have as an industry, which is very stable for decades, and in fact, it is going to increase because of the aging population, breakdown of the family units, and people having increasing number of medical and health issues in later life. So we have a huge, so to say, consumer database, and that is increasing. The third thing is that we will have a surety of the money coming in, which is a government-based surety that we have. As I mentioned to you, that probably definitely more than 85% of the funding comes from the government, so quite well insured. So then if you look into the recent industry research, you will see that there is most of the care homes or elderly care homes or nursing homes, they have about 90% occupancy. So there is a steady stream of consumers. So there's a property, there is a surety of the payment, there is a surety of your occupancy, and then finally, the most important thing is that you're dealing with the people, especially in Intercare, people like me, who have made their career in their clinical fields, medical fields, and you're dealing with kind of operators who have a track record of medical and health backgrounds, and that is a surety that your money, your investment will be looked after well.
Tell me, Dr. Qureshi, I'm not sure who's better to speak to this, yourself or Bhavan as the CFO, but if I invest, two questions. The one is, and someone's actually asked the question here, if I invest in London, or England, anywhere in England for that matter. But if I invest in London, if I get 3 or 4%, I'm lucky. If it's outside of London, 5 or 6% is great. So 10% cash on cash in the UK in pounds is a really solid income stream. So I've got two questions. One is, how do you achieve that? And again, please pass it on to Bhavan if you want. And secondly, when I invest, yes, I'm getting cash flow, but how do I know that my capital is protected? What happens if Intercare or someone disappears? Am I investing in an actual asset?
Yeah, okay. Yeah, well, I must say it's very easy because it's a very simple and straight. One, first of all, the elderly care market is working at about 25 to 30% of profit margin. And that is sufficient for any organization to pay as a rental income or investment, whatever you call, so 8 to 10%. Also, there's a sufficient for the organization like us to reinvest in the business to develop us furthermore. And then there is enough for everyone in the management board for Intercare. So people can search that what is the going profit margins in the country, and you will see that majority of them are very good majority of them are 25 to 30%. So there's a surety that there is a steady market where you can. The investment that people will have, they will be actually investing in the property. So they will have a piece of a property, just like the care home that is on your screen right now. So there will be they will have a piece of that in terms of a room, which will be leased, which will be registered through the lawyers on the land registry, so they can say that they have it on over 250 years long lease. So your property is not in a thin air. It is actually your investment is not against the thin air. It is actually against a property that you can see, which is vouched by the UK land registry, and all of these deals are done by the solicitors.
Brilliant. And I think the last thing that I would just say, and there are some questions coming up, but we'll do it when we get to the Q&A. I'm just conscious of time here. Is that something you mentioned last time was that Boris Johnson said that when the UK leaves Brexit, they want to put another £350 million into the NHS, which is the National Health Service. And the part that I like as well is that what I've found is that generally you have more success and get better returns if you're in a niche market you understand. And you guys aren't just in aged care, but you're actually in dementia care. And again, with all your qualifications as a psychiatrist, etc., that allows you to be, specifically niche. And that again is just an awareness for people to understand. They're not just in vanilla aged care, but actually in specific dementia care, which is when you've got dementia, you've got dementia. And what's interesting is there's about 100,000 people with dementia care at the moment, and that's looking to increase to about 500,000 if I've got my numbers right from the last webinar.
Yeah, that's right. Yeah, absolutely. There is a huge saving from this Brexit. I know that is controversial. However, the government has already pledged pre-COVID to put a huge amount of money, not on 350 million, actually it is in billions. So they said anywhere between 150 to 350 million a week. So we're talking about over 5 years.
Sorry, a little bit different.
Yeah, it's much. It's actually the billions of pounds are going to come back into the NHS, and elderly care is a huge part of that. So that is one part. The second part is this of your observation that we are not absolutely vanilla residential care. So for people who want to know what is happening in the UK elderly care, so there is a residential care. So these are those people who will need a very basic kind of a support system. But then stepping up is those people who may need nursing care. So that means that they may have high blood pressure, they may have diabetes, or they may have other cancer or post-cancer ailments. And then you have a category of dementia. That means they have a much more serious round-the-clock needs depending on their risk. So that is a growing market where the margins are more, where the revenue comes more. And then we have also people with the mental health issues on top of all of this. So that as we grow from the first residential upward, we become more and more specialized. And that is where we are getting towards. So we will, over a period of time, will gravitate more towards the more specialist area, which is dementia, nursing care, and the mental health issues on top of these physical health issues.
Brilliant. No, well, thank you very much. It's certainly a sector that I'm interested in. And as I said, you've got niche commercial in America, earning you dollars. You've got niche commercial in England, earning you pounds. Let's move to a different asset class, and that's actually structured notes, and also paying in the region of 8 to 10%, both in pounds and dollars, depending on which exchange you choose. And from your perspective, Chad, tell us just a little bit about a structured note, and in the current market, how do I protect my capital, yet take advantage? The markets around the world have lost 30 to 40%, depending on where you talk about. I know we've had a bounce back, so it depends. But the point being is that you take advantage of where we're at and get that predictable income that you speak about. Just in layman's terms for us dummies that didn't get invited to the party.
So Scott, I wasn't invited to the party for a long time, so don't feel left out. So what's incredible, banks would put predictable income contracts together, and what they do is they'll define exactly what that return will be, and they'll define what the protection will be. So we're able to set a band in which the bank would pay us an income, and we can also buy protection in case the market goes down. So you heard Andrew chat a bit earlier that it's possible to make money in a rising market, obviously. It's also possible to make money in a flat market, and it's also possible to make money in a down market. And the banks do this by combining two products. They link bonds to this, and they also link options to this. And in both trading markets, they could make returns. So what's quite amazing is products that were created in February, for example, have managed to go through the market crash and have continued to pay out. And what we're able to do then is define the amount of protection we have for our capital and for our income. So just to give you an idea, Scott, in terms of those returns, I've got a document here saying the S&P 500, if we were invested in that since 2008, it would have paid out a 6.4% per annum. We would have the up and the down cycles, and I'd have to sell out of those stocks. What's very different now in the medical we've just seen and in structured notes, I'm going to get a defined payment every quarter. So on the 10%, we're going to get our 2.5 every quarter, and I can live and I can predict off it, which is phenomenal. The big difference, and you've been able to bring commercial real estate to us by combining people together. Cashboxes followed exactly the same process. So banks would only put these products together if you went to the bank with $1 million or more. They wouldn't do this just for you and I if we came in and try to set a 32-day or a 1-year call account. So by aggregating funds, we've been able to put these products together that the bank says, yes, let's structure this for you. And the WealthE have been doing this for years and years and years. Ken, I think, has been experienced with these, and Andrew. And it's just because of that high barrier to entry, we've just been excluded for all this time. A, in understanding that it exists, and B, being offered the product. So even through the crash we've had now, we've got clients that are sleeping comfortably at night. Their assets are protected. So it's almost investing in the asset market with this level of insurance built in.
So interesting, because when you first explained it to me, you said that you mentioned $1 million, and the returns there are 8, 10, 12%, whatever it is. And yet I'm like getting 3%, and I was like, how's that work? And you said, no, well, that's retail, and then you've got wholesale, and then you've got institutional, and all we're doing is helping you cut out all the middlemen and go straight to institutional, which again is pretty much what technology is allowing us to do in all different asset sectors, whether it's aged care or niche commercial in America, or multifamily or medical or structured notes. It's all the same thing over and over again, where it's allowing people to participate up the value chain.
And Scott, on that, this contract, folks, is directly from Goldman Sachs investment bank to you. There's nobody between you and this investment. So all those mouths are gone. The returns are back to where they should be. You and I. Super excited about this.
Awesome. Well, as I said, we're so excited. I'm going to let Ken talk about this just now a little bit, but we're so excited because I've always loved business and property, and now not only am I getting access to different investment opportunities, but equally so are others. And I keep coming back to Ray Dalio's principle of having 15 quality assets that are not tied together. And most of us would sit and go, well, how's that even possible? I probably couldn't even come up with 15 if you put a gun to my head. And now hopefully we're showing you today how actually you can. There's multiple assets, multiple countries, multiple currencies that people can participate in. And when you come back to this Ray Dalio quote, and from your perspective, Andrew, you've spoken so much about diversification. And if I go back to your notes here, I loved what you said. People want certainty, they want protection, and they want income, and they need that through balance and diversification. Which markets are people looking at? What geographies are people focusing on? It doesn't matter where they live in the world. It doesn't matter where they actually live. Where do they want their capital to live? What's their capital investing in?
Thanks, Scott. Yeah, look, it's you always have a currency of reference and a country of reference, and that's generally where you live. But the multifamily, the ultra high net worths have multiple streams of income. They have multi assets around the world, lifestyle assets around the world. And that's not to say that you and me or you and I can't have the same type of exposure and the same type of diversification in different geographic spaces. Might be at a different level, but we can still achieve this. When you talk about diversification, one of my oldest families I look after, they're Scottish. So no Scottish jokes, and apologies to anybody who's Scottish on the call. But the one client, he's no longer with us anymore, he's passed away. But the dad said to me, he says, laddie, I think I was about 35 then, he says, laddie, diversify my portfolio. So I said to him, I like to answer questions with other questions. So I said to him, well, what do you mean by diversify? He simply said, laddie, simply rotate my winners. Okay, which sounds a bit glib, but in a way that explains a lot. You are constantly moving your various assets into various spaces at various times. You've heard that word time come up by a number of these very very eloquent guys who manage huge amounts of money. Time is important, and time is a commodity that is not it's not unlimited. So bluntly put, diversity is simply the practice of spreading your investment instruments, so your exposure to any type of asset, geography, or currency is limited when there's a downside. What does that do? It reduces volatility. And with active management, if you've got a good manager on your side, that's going to give you peace of mind at night. Diversity now, the face and the space that we all looking at these horrendous numbers of infections and deaths on a daily basis, it's almost a morbid fascination of who's going to reach a certain benchmark first. But we are not going to, as I said to a client yesterday, I said, it's particularly key now because we are not going to return to the world as we knew it. Behaviors, cultural norms, values in investing is going to be seriously tested. There's going to be a serious change. And what I've done simply, I've sort of synthesized 5 tips, if I can give. I wouldn't say these are investing tips, but these are 5 generalized tips that you can.
We are not giving investment advice, but yeah, perfect.
So it's not investment tips. It's just 5 synthesized, pretty commonalities when you look to diversify, and I'll just reel them off quickly. So if you want to keep focus on diversification, that's what my clients are asking for increasingly and in a very focused way now. So what would be those 5 major sort of thrusts? 1, spread your wealth, okay? Not just across currencies and economies and time zones and geographies and in equities, bonds, cash. Think about what Ken spoke about, private equity. Those type of funds are there's huge opportunities with the right business, with the right balance sheet, with the right leadership, investing in things that you understand and know. Certainly some of the commodities, but go beyond the norm. Question simply breaking out of unit trust or money market funds, because you literally are going backwards there at the moment. It's not actively managed. Second sort of thrust would be create that predictable income. We've spoken about the wealthy families look for predictable income first. Growth can come later. And look at it via a range of instruments, diversified instruments. As Chad said, he needed to get away from just property. And certainly I've had structured note clients that want investment into like that Scott and Wealth Migrate would offer. So there's a great synergy there. So look for those opportunities. Third sort of point, always keep building your portfolio. You don't have unlimited time, okay? You might have limited funds, but when those funds become available, use them wisely and take advantage of those peaks and troughs, okay? Because that's what comes with times. It's the unpredictability of time. You don't know how long you're going to be here. You don't know what's happening in the market. So keep building your portfolio. This is a difficult one. You probably all heard of bulls and bears. We all know what they do. When I was stockbroking, there was also a term known as pigs. You need to know when to get out, okay, and not just keep your nose in the trough. Because unfortunately, we know what happens if you leave it in too long. You take a bath. So don't stay on autopilot. Don't let your portfolio stay on autopilot and say, well, in 20 years' time, I'll look back and it will have recovered. It needs to be actively managed and stay current. This is the last one. Stay current, stay relevant, and stay abreast of all the trends. And the trends that are coming out of this, I think, an amazing opportunity that was garnered together with some very clever people, as Scott mentioned, in terms of let's blend all these great ideas into one simple go-to product, and that's certainly the blended portfolio. I think that's enough from me, Scott.
Awesome, Andrew. Thank you very much. Hank, from your perspective, someone actually asked, Patricia asked about Wealth Migrate China and what you guys are doing there. And just last night there was that webinar of the incredible results you continue to get out of China. Tell us just a little bit around what you're doing in China and specifically your affiliate strategy there. I love when you took me to meet Chang Tao and why that growth is so palatable. And I think if you remember, if I remember from the webinar, you've done five times the equity in 2019 that you did in 2018, and the growth is amazing. Talk to us a little bit about that story, please, because again, China for me is a beacon of where the world's going.
Yeah, definitely. There is a land of opportunity here in China. I first joined the team back in 2016. I think we had a very good idea, very good products, and we know that the Chinese people love to invest into property, both domestically and internationally. It's saying that property or house, apartment is one of the essential assets for guys here to get married. The second one is automobile. So, and they love to invest in property. Just to give an example, I think last year when the tension in North Korea was kind of lower a little bit, I think there are people wanting to get in Pyongyang very early just to get in on that opportunity. So definitely there are opportunities here. But when we first approached to our clients here in China, I think like everybody else, we think we go to the higher net worth group. But we soon find out that these people, they are surrounded by a lot of advisors, brokers, and etc. want to get them to invest. So being a new kid on the block, we don't really have much credibility to get them to invest with us. So very quickly, we adopt a new strategy. We just start to look for affiliates to kind of help us to spread the word, because we know essentially our technology and our products gonna change the way people here invest into global real estate. And then we were very fortunate to meet one of our key affiliates, like you say, iChangtou. They are an online educational investment education platform. And then they, I think to date, they have over 3.5 million paid users. And then last year they closed their Series A.
Sorry, just to put it in perspective, I was there in March last year, and they had 2 million paid users in March last year.
Something like that, yes. Yes.
So it's nearly doubled since I was there a year ago.
Right. Yeah, because they closed their Series A last year, which they don't need. They are already profitable, but with that funding, they're gonna accelerate their growth. And so yeah, they very quickly they add like 1 million users like that. And then for Series A, I believe they were valued at 1 billion RMB. It's not quite a unicorn yet, but I believe they are working on their Series B, which will for sure put them over $1 billion valuation. So so when we started work with them, we didn't know what was happening. But when they first tried with us, I think what their users very quickly they just kind of soup up, what we're offering. And then last year was really a breakout year for us. Like you said, I think in 2018 we raised about 1.2 million or so in terms of equity. Last year we did about 6.2 million. So that was a tremendous growth. And then with the same amount of, we didn't add any personnel, still with the same amount of staff that we have, the 6 people here to do the service. So definitely that's a game changer for us. And then for this year, since everything is done online, even though we have about 2 months of time during quarantine, but that gives us enough break to kind of enhance some of the capabilities and services that we'll be providing to our affiliates. And then we are continuing to pick up a few more here in China. So, and then I believe what really changed the landscape is that the adoption of, like you said, the WeChat app. Over 1 billion users is using it, and that's how both us and them are using that app to kind of having that social media effect. So for us, we don't really spend too much. We don't really spend on marketing. We believe the word of mouth. And then I think during this difficult time, like as our portfolio are continuing to perform, we are getting very good feedbacks from our affiliates as well as their clients. So I believe we still, even though the first 2 quarters are a little slow, but I think we're going to have some legs in the 3rd and 4th quarter this year.
Awesome, thank you very much, Hank. And I just thought I'd bring up this slide, which is an old slide. We created this in 2015, but it's just the adoption of people online. And people start with publishing and then social media and then e-commerce. And we've been talking about how the two come together, and ultimately it's social commerce and investing online. And we still don't have massive world adoption, and yet in China this is really happening fast now. And with Corona, we're just seeing this acceleration around the world. So when Andrew talks and Chad talks and Dr. Qureshi talks, and I'm about to pivot to Ken now, these are the trends that people need to be aware of, and we as both investors, and people that want to participate and watch from the sideline, we can see these trends happening. And I think, Hank, I really appreciate you being online tonight, because I know how late it is there. And if it wasn't for people like you and the experience I've had in China, I wouldn't be able to talk with as much authority about what's happening, because I've seen it with my own eyes, whereas I don't see it in the Western world. It's not happening yet in the Western world,
Definitely. I mean, I only heard so much about China before I moved here, but everything is different. You have to really experience here for yourself. I mean, if I'm out of Shanghai for like 3 months, I think something new is going to get built, it's going to be so different. But back in LA, I think it still looked the same when I left 10 years ago. So I think that's what the different pace between China right now and what's happening back in the States.
Yeah, well, that's what that's what I learned, and I mentioned earlier about Jim Rogers. It's just amazing about playing to where the world is going and not where it's coming from. So Ken, I want to pivot to you, and you spoke about private equity. One of the things that you guys spoke about in that initial conversation 2 months ago was how to allow people to participate in our company. We have allowed people to participate in our company and be shareholders for 6 years, and it's been one of the most valuable things that we've ever done in the company, because it's allowed people to participate. We've got this global community, we're learning and growing all the time, and yet it's always a challenge, liquidity, how do you do it, cash flow, risk, etc. And so this value chain that you've got in front of us here is something we created when we did the Seeders campaign, and we've now got 863 shareholders from 43 different countries. But talk to us a little about, with regards to your experience, what is happening in Wealth Migrate? How is COVID affecting, the company, and equally, what is the opportunity? What even is a debenture, with all due respect?
Thanks. Is my sound working, Scott?
Yeah, we got you.
Terrific. Okay. Well, this is where I get excited, because this, I came on as a wealth partner. And I joined Scott because of his vision and because of his drive. And what has he done? So basically, in recent times, he's done 3 corporate things pretty well. So using a modular open source technology, WealthE Migrate has built and launched a technology platform that provides a book building infrastructure. And he did this specifically so that he could reach those people that didn't have access to property, and he could do it at global scale. What does book building infrastructure actually mean? So being a banker, if I can use it in my terms, if we all leave here and we go and buy Google, you phone your stockbroker and you immediately ask him for a price, and then you agree that price. As that is struck verbally, basically what we would have done in past times is we would have timestamped that. Our book building infrastructure is organized from a primary perspective such that it does exactly that. And I'm going to give you an example of exactly what it means. So say, for example, I was approached this evening to place $250 million US in Google, and my bank was Deutsche Bank, where I used to work. And we were given that in syndicate. So in other words, there were 6 other banks involved. Basically, as we start, and I go out to my client base and our colleagues go to their client bases, we end up getting interest, and as that interest comes in, it's time stamped, and so that you form a very, very good idea of who actually sits in the book and how you actually book build that book. Now that is done automatically through the book building infrastructure that we have. Why is that important? Well, 2 other factors occurred. Is to be able to do this, we needed a global authorization home. So we created a fund that is able to invest in these assets. And when I say these assets, originally it was properties. With that authorization, what we wanted is we wanted a straight through payment solution, so straight through processing. So we didn't want a team of people sitting in a back office for us actually processing these transactions. So with the authorization, we were able to go to Europe's largest payment solution and onboard with them. Now, their global custodian is BNP Paribas, and they've got 4 other tier 1 banks that they work with. Obviously, they had a good look at us. They had a good look at the authorization, and we've onboarded. What happened then was Chad came along and said, hang on a second, we can actually use your infrastructure for our benefit. And then sitting in front of everybody in South Africa on the panels, someone needs to mute, please, because I've got some comeback.
I'm gonna, Ken, I'll mute, but just so that you know, while you're talking, I'm actually showing some of the visuals of what you're talking about.
Okay, perfect. So sitting with Chad, in fact, I was sitting with Chad and Andrew, and I believe at that time we had Garth sitting with us as well. And then one of our partners who had a very exciting American multifamily project in Brendan Brown. And basically what happened was we were asked whether people could invest in WealthE Migrate. And then no sooner had that sort of happened, then Chad got up and started talking about his structured product, and people wanted to invest in that. Now, the interesting thing is all of these products reside on our marketplace. So we can do, and we have done, they actually exist immediately, is equity. We can do debt. We can do structured products, because Mr. Structured Products is on this call. We can do funds. So what it's done is it's actually presented us with a means to provide a universal application for financial transactions. So to go back to Henk's point, we've actually taken a feather out of Henk's cap, in that now turning to COVID-19 and how it's affecting us. Henk said that they changed their strategy and they went to an affiliate. Now, we in WealthE Migrate at the group level call that B2B. And we've only had the ability to go B2B. So in other words, to white label really effectively in the last quarter, almost kind of, just prior to shutdown, although we had negotiated for quite a long period of time. And it's just, it's just interesting to report to you that at this point in time, we have 4 signed contracts with institutions, and we've got 5 further businesses that we are in advanced DD with in terms of just B2B businesses. So, think of what those are. That might be a wealth manager that has thousands of clients. He has a new product, but he can't actually match the two. So he can come to us, he can just white label, basically nothing changes. It's his business. You don't see Wealth Migrate anywhere you use the technology, and we can provide that for him. That comes through our platform, and that will grow our valuation. Equally, it might be a property developer who actually has clients that very much would like to stand next to him in his business, and that's a little bit like the doctor himself, or he might have both. So he might have just a property, and he can list it and go through our global audience, or he might have both investors and his property, and he can white label with us and work with that going forward. So what it's done is it's provided us with an amazing opportunity to size up the products that we've got, and then say, okay, well, how do we meet the request of our investors? And that was, they were quite interested in actually investing in us for the sort of the palpability of the exponential growth stream that we're looking to, and we're forecasting to grow by. We've gotten to COVID-19, and they said, well, can it be somewhat de-risked? And so we sat there and we said, well, absolutely it can, because we can take a group of the assets, exactly like Chad Pope is taking a very nice blue chip suite of equities. We can take our assets. We can take Chad's structured note. We can take the doctor's, and that's a mix of both US dollar and sterling. We can go to a care home in the UK. We can go to a large multifamily or medical facility, for example, in the States. And along with that, we can actually put Wealth Migrate in there. And what's the best way of doing that? Well, we thought, okay, well, what would be most useful? We thought a convertible debenture. And how does that work? Generally, a convertible debenture is issued by a company that is prepared to make some of its stock available to investors. But what it will do first, before that time horizon strikes, is it'll actually provide a yield. Normally it provides a very low yield. So what we said is, to make this product really palatable, let's be fairly generous. So let's do 6% in dollar terms. So we're providing a debenture in Wealth Migrate that converts on a 5-year window, along with the rest of the assets that we've discussed this evening. So what would end up happening is you participate in 4 asset classes, very diversified by way of geography, certainly by currency, and then by asset class themselves. And the big kicker is actually the private equity business. And I was really interested to hear Andrew go to private equity, because that's exactly the point that we're offering here. What we have done is we're offering US security in a private equity business that is this one, alongside the rest of these assets. What's very nice about this is that in future there could be a distressed set of assets. We could create a fund, and we could put distressed assets through our platform, and we could say, well, what we could do is they're called wrappers. If you're familiar with them from an institutional perspective, wrapper funds. We could basically do a wrapper in alternative or in distressed assets, for example. So it's not a case of saying, well, how does that exactly work? We are structured such that all of these assets exist already on the platform. So all we're doing is we're actually putting them together. Just finally, if I may, Scott, because you asked, is COVID, how has it actually affected us? And this is the thing that I marveled at the most personally, because coming out of banking, I wasn't particularly techie. And so internally, Wealth Migrate has operated consistently as a decentralized business. And so we've really used Zoom, which really a lot of people in the world, Zoom only had 10 million customers before COVID. They've now got 300 million and counting. A lot of people didn't know about it. So we used Zoom, we were decentralized, and this is how Scott built the business. This is exactly what he wanted. He wanted to get the right people. It didn't really matter where they were, as long as they presented the skill set. As a result, the crisis itself has in fact helped us with the efficiencies within this business. And so it's actually led to us structuring this product over the last sort of 4 to 6 weeks, where we didn't have this product before. Regarding the properties, let's leave out structured notes, and you know how those are currently defended or underwritten. Regarding the properties themselves, there is a due diligence process. Key for Wealth Migrate is that Wealth Migrate only takes deals on where the shareholders can invest alongside the real estate owners or developers. So in other words, if you did invest alongside the doctor, what you would get is you would get A-class shares in his property, and he will give you a slice of that, which he's going to continue to run with his team. So you're sitting equal to him in a very small slice that you would never have had access to before. And that's with his years and years of experience in this side of thing. The other thing is that we look at companies with long-term leases, and if you heard what he said earlier on, I mean, he is in a sector that is specifically defended. So, actually the assets as we see them on the platform at this point in time are not generally affected. We've had nobody approach us with significant problems of one sort or another, and the yields remain intact.
Ken, thank you very much. I am conscious of time here, and I do think that you and Andrew have answered my next question, which is all around balancing. And to Tion's question, he's like, hey, Scott, why can you see all these products on the platform and I can't? Tion, you've got to know the special handshake. No, there's the difference is that we've got the Wealth Migrate platform, which is real estate only, and then we've got the alternative investment platform. We are looking to solve that. But I think one of the things that makes me most excited is that, I'll be frank with you, I thought we were building only a property platform until a year ago when Chad came and said, could we do this? And then Gavin and Lyndon and everything said yes. And now whether you want to build a balanced portfolio, you can actually do it all in one place. You saw my digital wallet, as Ken said, your money's protected by European law. And wherever you're investing, it all is coming back completely seamlessly. We've had people invest, we've had people take their money out, and it's so awesome not to have to deal with humans, not to have to print docs and scan them and pay money every time I want to get access to my money. So it really now does allow you in a digital way to build this portfolio. I want to finish and then there's been so much valuable information. I never expected us to nearly hit the 2-hour mark, but Roger Hamilton talks a lot about Investor 5.0 and how growth is ultimately determined by the investors. And so when people say to us, why are we doing private equity? We had someone say, oh, you're just trying to put Wealth Migrate in. Not at all. It's because this is where the future's going. And ultimately, the more you grow your community, if you're a community company, the growth is ultimately determined by your investors, and you've got the finance, the founder, and the growth working together. And I don't have time tonight to talk about it, but it's not actually about unicorns, it's about zebras and where the world is going. Equally, it's about Wealth 5.0. The world has changed, and Hank very kindly, gave us a window into that. And there's a great video that if you want to watch on the future of money and what you can learn, and where Jim Rogers is one of the people talking about that in China. And this is happening with or without your permission, and you either get to take advantage of it or watch it happen. And when one looks at Wealth 5.0, I've done whole webinars on this, so I'm not going to go into it, but it's about your impact. It's about the amount of money you're going to make. It's about your creativity. It's about how many people are you touching and adding value to. It's about the technology you're using, and ultimately it's about problem solving. And I did say to people that were joining us on the webinar, the 3 most important things you need in these current times is you need the right information, you need access to the right partners, and as Andrew, I think, has summed up so eloquently, is you need diversification. And this is really what Wealth 5.0 is all about. From our perspective, we've been around the block a few times. We've got members now in 133 countries. Just as a matter of interest, we've actually got investors. So not, some people think that 5 or 10 countries is quite a lot. we've actually got investors that have physically put money in from 62 countries around the world. Over $100 million invested on the platform. We've won numerous different awards. And I think what excites us tonight is just sharing with you the different opportunities. And really, it comes from a team of people and a group of partners that have their specific niche experience. All that we've done really is bring it together and make it easy in one product to be diversified. And we're calling it the Wealth Diversification Portfolio. To sum it up and to summarize what Ken said, you've got access to the best performing property sector, real estate sector in America, niche commercial. You've got one of the most resilient property sectors in the UK, aged care. You've got fixed predictable income, which is taking advantage of the stock market and earning that fixed, predictable return. You've got a private equity investment in a global growth company. Through the global company, you've got access to what Hank and the team are doing with the Chinese growth opportunity. And ultimately, it equals 6 assets, 5 countries, 6 assets, 5 partners, 4 countries, 3 continents, 2 currencies, and 1 result: diversification, income, and protection. And so if wealth protection is something that's important to you, if you want to protect your wealth, we can talk about it more, in terms of how we do that. If you would like an 8% cash on cash return, and if you would also like to take advantage where there's a potential upside, then that is what we've created, the Wealth Diversification Portfolio. And as I said to you, I showed you my own digital wallet. You can literally manage all your money now in one place, which truly excites me, because I'm useless at managing bank accounts and trying to manage them all in different places. So just in terms of the levels, we are going to have 3 different levels. There'll be the silver level, which will be $25,000 up to just short of $100,000. There'll be a 2% fee. People know that when they invest on our platform, it's traditionally 3%. So for the silver, it will be 2%, and that will be it'll be put in there for 12 months. So anything you invest in for 12 months. The gold level will be 100 to 250, and there'll be a 1% fee, and that will be for 24 months. And then finally, we'll have the platinum level, which is 250 and above, and there'll be no fees, and you'll be actually put in for life. And so the best way to describe this is where we're going with the platform is that it's very much like flying on an airplane. When you silver, gold, or platinum status, and the different rewards you get, and the team can talk you through that in terms of where we are looking at. The other thing that I think is important is that we are looking to launch on the 9th of June on the assumption we can just finalize some of the T's and C's. You can go to the pre-launch page, so you can see there it's online.wealthmigrate/WDP/apply. So if I just go there very quickly just to show you, and I don't think too many people have actually seen this yet, but effectively we've gone live, so you can put in the link there. And Lee, if you wouldn't mind, or someone putting in the link, you can basically see it's really simple. There's 2 steps. You can download an information sheet. So it's just a 2-page fact sheet. It's not a brochure. It doesn't have all the detail. The detail is on the platform. So I'll tell you a funny story just very quickly. I went to the event in 2014, one of the big real estate crowdfunding events in New York, and we had a massive stand, and we had all our brochures and everything else, and Fundrise was there, and they had no stand. And I was on a panel with the guys, and they said, they asked the Fundrise guy, why don't you have a stand outside? And he said, because we're an online business, all the information is on the platform. So in the same way, we've got a fact sheet that makes it simple, and it's all in one place, but all the detail is on the information. You can go and download it. And then really it's about registering, so register your interest and basically talk to one of us. Sit with one of the team. You can go why you should consider it. You can look at what's involved. You can look at some of the returns. You can watch a video on it. And in simple terms, what I would recommend is just sitting and having a one-to-one call with one of our wealth consultants, or Ken or myself, in terms of that process. So speak to us. This is something that we want people to understand. And if you're watching the recording, you can click on the link below. So to conclude, money won't create success. The freedom to make it will. And that is what this is all about, from Nelson Mandela. And so thank you very much to all of you for your time. I really want to thank the panelists. I'm terribly sorry it's taken 2 hours, but obviously so much information to share. We do have a Zoom room going live now. So Alex is going to, one of my partners and wealth consultants is going to jump into a Zoom room with the number being 766-282 8743. So if it's something you're really interested in and want to know how to get KYC'd, we're obviously launching, as I said to you, around the 9th of June. So you'd need to KYC, you'd need to fund your wallet. I, as an example, I'm sending money over to fund my wallet so that I'd be able to participate. And really what I'd like to finish with, if you don't mind, is I've got some polls that I'd like to ask people. And while we're doing those polls, Lee, if you could join us, and if our panelists wouldn't mind, and I really apologize for the time, but there's so many good questions here. And do you mind if we just answer a few of these questions?
Yes, certainly. Certainly.
Excellent. So Lee, if you're there and can join us, Hank, I'm very aware that it's like 4 a.m. in the morning, and so if you want to go to bed, I fully understand that. I think I've been to China enough times that I'll be able to help out and answer questions if there are questions around China.
You know, I don't sleep until like late anyways. No, I'm good. So I'll stick around for a little while.
Excellent. Okay, so I'm gonna launch some polls while we're doing this, and Lee, if you want to join us, and Fritz, I know you there as well as one of the wealth consultants. You're obviously dealing with all our people on a consistent basis, and they, asking you questions. So if there's any good questions that you think would be valuable to people, please do participate in the polls. We'd love to know your information, and whether you thought tonight was valuable or whether you got questions or would like to talk to people. So let's look at some of these questions, and Lee or Fritz, if you could please help me, because when I put the poll up, I battled to go and read the questions. So I want to look at the question here from a SA Rand investor perspective. Investing now with the Rand at an all-time low across currencies, would you recommend investing in the first world currencies at this time? The danger being that if the Rand rise again, even 1 Rand relative to other currencies would reduce 10% to 5%, a drop of 1 being conservative. So 2 parts. What is your opinion on this? Secondly, can we keep our investment through Wealth Migrate in that currency until we change back to Rand? So Peter, I hope I'm pronouncing your name right. We do actually have a webinar next week from James Painter. He's a guy that I've worked with for many years. He wrote chapter 2 of my book, and I followed him for more than 10 years, and he's got an incredible accuracy at predicting currencies. So the Rand, the dollar, the pound, the euro, and how they all interlink. It's going to be a paid for webinar because we need to pay him for his time. That's going to be next Thursday, and you can actually go along and be part of that webinar. I did, and I will be talking then about the impact of currency, because what's interesting when you're taking a 5-year investment, if you were trying to decide whether you should invest tomorrow morning or not, then currency plays a big part in terms of where it is today. But if you're taking a 5-year view, you need to look at long-term trends in terms of what to look at. And I don't know, Andrew, if you wanted to jump in there, I might be throwing you under the bus. But in terms of, again, when you're talking to wealthy families and balancing portfolios, one of the things I've learned is that when people react, they lose money, and when they're proactive, I mean, you mentioned about having active management. But there's never a good time really to call currency, in many people's opinion, because one person says it's going up and one says it's going down. What do you tell people in terms of, over the years they've been moving money offshore and taking into account currency?
Thanks, Scott. No, not at all under the bus. Yeah, look, it's I think you've hit the nail pretty much solidly on the head in terms of your timing view. Nobody can really get timing right. If we take a back, looking backwards with the brilliant clarity of hindsight, we're all very clever to say, oh, there was the trough and there was the low and there was the peak and that was the bottom of the crash. But whilst we're in it, we don't know where it's going. The one thing, I'm presuming we're comparing Rand, US dollar, for example, because some currency pairs trade a lot closer with less divergence in terms of margin. But the one thing that I've noticed, and again, it's looking backwards, so it's anecdotally, it can be supported. In South Africa, there's always something that comes along that surprises, and that surprises are generally on the downside. So there's a litany of things that have happened in South Africa, and at the moment, the currency has, the economy and their currency are closely linked. They're under enormous pressure, not so much from an external perspective anymore, but from an internal perspective. We've lost international status as an investment destination, as a sovereign country, with investment grade being junked. We've got massive unemployment problems, which are going to get bigger. We've got a massive deficit. it all adds up to a very poor story. So if you're taking a 5-year view and you are looking to build an offshore wealth platform, you need to understand, are you building an offshore wealth platform to increase your wealth outside of this country, or are you using it as simply a conduit to bring money back in and arbitraging the differences between the two currencies and scoring when the rand falls out of bed? Most of the families that I represent have it's a bit of a culmination of both. They generally try and use their rands, and they externalize when they externalize their rands, they don't try and bring it back. So theirs is a 1 point sort of allocation, and if we took money out at 18, let's say 1850, and tomorrow it's 18, I don't think you must lose sleep over that margin. Sure, you want to be a winner, you want to come out thinking, well, I finessed that quite nicely, but in 15, 20 years time, if one honestly says, well, where might the rand be? If one looks consensually amongst all the analysts, the quantitative, qualitative analysts, the banks, the institutions, there's a fairly negative Afro-pessimistic view against, and Euro-pessimistic view against where the rand's going to be. So yeah, certainly come back to that point of diversification, keep building your portfolio. My advice is keep building an offshore portfolio. So yeah, live in a warm climate, live in South Africa, but keep some of your money in the shade and keep it there and don't bring it back.
Excellent, thanks, Andrew. It reminds me of 2 stories, and sorry, I'll keep this short because I know there's so many questions and relate. But 2 stories. One was that, back in 2013, the rand actually got to, well, 2011 it got to 670, and by 2013, we were helping people invest in American property in those days in distressed assets, and I remember the rand slid to 880, and this one guy bought a house for $80,000, and it was 880, and he signed all the documents and everything, and he pulled out at the final minute. And I said, well, dude, like, why are you pulling out? He said, no, and by the way, I can't mention this person's name, but he's one of the most well-known property people in KwaZulu-Natal. And he said, no, his bankers told him that it's going to be 8 rand by the end of the year, and so he's pulling out. And obviously, as we know, it's whatever, 18.50 now to the dollar. And every time I've seen him since, I've joked with him and said, geez, how good was that advice? And the fact that the asset value is probably nearly doubled, he could have earned an 8% cash on cash income the whole time, and so playing the currency game, it hasn't worked. And the other thing that I found personally is that the wealthiest people, it's where if you look at Ray Dalio, he said, don't try and market time, be humble. And what I found from the wealthiest people is they've got consistency. And so the second part of that question was, can I leave my money offshore? And that's the beauty of the Wealth Migrate platform and your digital currency is that, your digital wallet is that when your money is offshore and it's in US dollars, if you invest in America, the asset is held in US dollars. If you invest in England, the asset is held in pounds and the return is in pounds, et cetera, et cetera, et cetera. And if you invest in a structured note, it's the same thing. So, but you're assuming it and getting it all back into one place. Ken, there's a question here regarding the convertible debenture that Wealth Migrate will issue. Is the cost to Wealth Migrate not expensive at 6%? Will it not affect the valuation of Wealth Migrate negatively and increase the risk?
So it's relatively generous. However, the benefit here, Scott, is if you look at the forecasts, there's a lot that we can do with the cash. So Wealth Migrate has the ability to significantly kick up its revenue through things like digital marketing. We've got a new chief digital marketing officer, and basically we could be acquisitive. That means that we could actually buy into businesses that provide us with revenue. And remember that we raised $2.5 million through Seeders. 654 people participated at a 10 multiple of our revenue. So every time there is an opportunity for us to lift our revenue, there's a 10 multiple to the revenue number by way of valuation enhancement. So we've looked at it quite carefully. It's important to note 2 things. One is that Wealth Migrate through these wallets never touches the money. So in other words, it goes into escrow, goes into the deal, goes back from the deal into escrow, and goes back into your wallet. So if Wealth Migrate ceased to exist completely, you would still have your assets. So that's the whole point. It's just like Amazon. you buy something off Amazon, it's a transmission mechanism. With regard to Wealth Migrate specifically, in terms of the debenture, we'll obviously use that capital to the best ability of the business to generate the wealth for the business. We will ring fence the 6%, okay, so that there can be no doubt that the 6% will be payable on the 5-year view. We'll ring fence it immediately on receiving the capital, and we'll use the rest of the capital for growth capital in the business, which is what every private equity company does when it issues debt or equity. It's essentially to grow its business.
George asked a question which I'll just answer very quickly. How has Wealth Migrate performed in the first quarter, and does this tie in with our expected? So it's interesting, George, because the one challenge we did have was the wallets were due to go live when we did the projections at the end of December, early January. Unfortunately, it took us another 3 months with dealing with the compliance. It's what's happened when you're dealing with BNP Paribas, one of the biggest banks in the world, and we went live in early April. So it did stall some of the projections in terms of not us hitting our numbers in the first quarter. But what was so interesting is that it's built up such a damn wall that in Q2 this damn wall is really running now. And even with the starter packs and people being able to participate, Ken's already mentioned partners coming on board, so it really has unlocked it dramatically. It's been a huge catalyst for us. Cashbox, I want to confirm my understanding of this investment, that capital is guaranteed until the investment incurs a loss of 35%. If losses are higher than that, the loss is realized in a loss invested capital at the end of term. Chad, do you want to talk to that? Because it's a question I asked you when you first told me about the product.
Yeah, super, Scott. So what I'd love to do is invite everybody to go and have a look at our intro video on cashbox.global. It'll highlight exactly that point. And the great news then is our capital is protected through the life of the product, and only at the very end of the product, 5 years, does the bank have a relook to see where the stocks are. And the depth of protection we buy typically is way deeper than what we'd ever imagine the market to be at that point in time. So give you an idea, and I've got the stats from our affiliate who helped us structure this. In 96.1% of the products that they've ever built, they've all performed exactly as projected. So 3.9 have had some capital loss percent. But if I could go and invest at that kind of return and that kind of track record, I'm really comfortable.
Thank you, Chad. Graham asked, and Dr. Krish, I think we sort of touched on this, where a lot of the deaths within England have happened in the elderly sector and even in aged care. I know we talked about it earlier, but specifically from your perspective, you spoke about it both from a social perspective and from a commercial perspective. But have you found that COVID is having does it cause problems to the investment asset and the returns? I know that sounds very what's the word called, non-caring, but as an investor.
Yeah, I don't think there's really much to worry about. I mean, the world will be in recession, but this is a very stable market. There are people who will need care no matter what happens, and there is a government who will ensure that those people are paid well. It is just that one should invest with a company which really is very clinically driven, which is able to manage these elderly care very well and to ensure that the margins continue. As I said before, that the way this market works, so if we have slightly less number of patients in our care homes, that basically means that our expenses are reduced. So margins more or less stay the same. So I'm not really much concerned about it. And in fact, we take it as an opportunity, because we are able to demonstrate that we are a very safe, caring, and a professional and professionally and economically and commercially very viable service.
Excellent, thank you. Andrew, I'm not sure if you want to give this one a bash, but the question here from Roy is, how do we mitigate the effect and risk of COVID on our investments, especially our pension funds and our endowment policies?
Yeah, it's a very, very difficult one. Well, the question was from Ken, did you say?
Roy.
Sorry, Roy. Yeah, look, the whole thing about a passive, you had a passive and an active investment. A passive investment is pretty much your asset management approach to, let's say, unit trusts, where the mandates are given to the investment managers, the portfolio managers, who are paid a lot of money to act within their mandates, to stick to their mandates and apply the mandates in their investment asset class. The difference between a unit trust and, let's say, a discretionary portfolio, which is more actively managed, is that the portfolio manager, and a good portfolio manager, would have seen the warning signs pre-COVID, actually, that the markets were actually in a bubble. Price earnings valuations were through the roof. Companies were not being valued correctly. It was very, very expensive. And a lot of people actually in Q4 last year and into the early parts of this year, before the COVID thing really got going into China, were taking a lot of money off the table. And those that were staying in the game, so to speak, in active equities, were taking a very active position in terms of buying options to protect the downside. So it's a cheap strategy. Let's say buying put options to protect crash, sort of crash environment, which a lot of the big private banks did, a lot of the family offices did. Whereas your fund managers don't have that mandate. They've just got to ride out long-term, that sine wave of ups and downs and troughs. So yeah, it's very, very, and it's caused a great deal of concern for governments, because obviously there's a lot of people in a pension position coming to the end of their working career, where their pension is now going to be defined in terms of a value, that they now have to pull the trigger and create annuities if it's an insurance product, or actually start taking capital values, and they might not be able to because they're distilling losses. So in unhedged equities, in such a bull market, which hit the big bubble last year, that's why I say greedy. It was patently clear there was a lot of greed going on. What we've seen this year in terms of the recovery from sort of late-ish March up until currently is that there's been a bear rally. I think there's about 90% of big fund managers in the States regarding this not as a true rally. It's a bear rally. People went, a wall of money just went flooding into the market, buying cheaply valued quality stocks that are just shot out. The problem is there's a complete disconnect between the price of those assets and what the economies are doing, because the economies are in trouble. And people are just pouring money back into those companies, and their earnings aren't there. So there's going to be more volatility. And I would certainly be suggesting, if you're in unhedged position and equity positions, is to be advising your advisors. We need to put options on these things to try and protect them to some degrees. But yeah, that's active versus passive. Too many, and this is a South Africanism. Too many people put their investments in their top drawer. They said they've given something that says something on the box, and when they open the box 10 years later, it's completely a different number. Chad, in fact, said to me, he was very diligent as an investor. He contributed every month. He ran cost average. He did all the things that a financial advisor told him to do. And 10 years later, he was looking at a situation where he hadn't actually made too much money. So you need, as I said, you need to have relevance. You need to have a reference. You need to keep up with the trends.
Thank you, Andrew. Again, I'm conscious of time, so I'm going to try and jump through these. Denise has asked about what the structured notes are underwritten by, and I suggest, Chad and Denise, I can put you guys in contact, because you have explained to some extent, but I know Denise, loves the details. So Chad, I suggest you guys chat one-to-one about that. With George, he's asked about providing the past returns over the last 10 years, and I think you've referred to it, Chad, in terms of the risk and what's happened, and not just the last stress testing, not just the last 10 years, but even the last 50 years. So again, that information is available, and we've got that in their brochures on the platform in terms of where it is. Brad is asking, these investments, do they have a stable guaranteed income? So not all of them are guaranteed. The structured notes are a predictable income, and my understanding is that as long as they stay within the margins, it is pretty much guaranteed, but it's not guaranteed 100%. Like, I don't know what percentage you would give it, but it's not 100% guaranteed, Chad. Or is it guaranteed?
So the product's guaranteed by the bank as long as it trades within that big band of predictability. And if we do miss one quarter, it's not lost. There's a memory feature. It may pay back Q2, it might come back and pay you again. So it's highly unlikely that you won't get your income.
Okay.
Highly unlikely.
The aged care is actually guaranteed, so it's one of the reasons that we've got it in the product. The property, the niche commercial in America is not guaranteed, although we are looking for the opportunity that provides that very sustainable income. The Wealth Migrate one, as Ken said, is being ring fenced, so it is pretty much guaranteed because the money is going straight into the bank to be able to pay it. And which one am I missing? So anyway, to ask Brad's thing, I don't ever like the word guaranteed because nothing's 100% guaranteed, as Chad said, but that's certainly the real focus of this product is wealth protection and cash flow to be paid out on a quarterly basis. Okay, I'm in New York, how do I invest? Frank, please can you and I just reach out to me or the team and let's figure it out. There have been challenges around regulation and particularly with structured notes and the SEC, etc. There's sometimes we can't help you, but let me see what we can do to try and see if we can assist you. Brad has asked, what does a 10% cash on cash return mean? Basically, it's a net return. So if you invest $100, to keep it simple, you'll get paid a net return of $10 per year, which is $2.50 a quarter, plus minus. So it's quite important to understand that. How do you guarantee this diversified portfolio product? So again, I'd highly recommend that you go and read the fact sheet of the three different, so based on the prediction in terms of the target returns, how we've actually blended the product from a wealth protection perspective. What's interesting is one of the four assets can disappear completely. You can lose the capital. The other three can actually lose 20% in market value. And the way it's been structured is that even on that assumption, you would still get just a little bit more than $1 for $1 invested. So I really recommend going and reading that. And we've really tried hard through that diversification to provide people with that peace of mind. Cashbox is the 2.5% return guaranteed. So we discussed that. Patricia, how do I invest in Wealth Migrate China? So hopefully, Patricia, we've given you that answer from a RAND perspective. We discussed that. Where is Andrew based? In Cape Town. So Cape Town. Brad, we are looking for with Wealth Migrate a guaranteed income stream. The multifamily investments have not accomplished that. Can Wealth Migrate put together a mix of some assets that can provide that? Brad, that's exactly what the Wealth Diversified portfolio is. We've specifically done it from a diversification perspective as well, so that you don't have all your eggs in one basket, one asset, one country, one currency, or even one partner, as we've all learned. Okay, Damir, I need to leave you. Thanks for everything. We'll be in touch. Fantastic. Sorry, I'm just going through this very quickly. If there were any problems with audio, we did record it. When will the blended product be launched? So the target date is the 9th of June. We will, tonight was a conversation, and we will be updating, as we get closer to the time. But there's no harm in getting your KYC done, getting your money moved to your wallet, because it will be on a first come, first served basis once it actually goes live. Are there any investments to get started from $100? Yes, Lububalo, sorry, I hope I got your name pronounced right. You can invest in the starter pack. Tonight is not about the starter pack, but if you invest in the starter pack, you can invest from $100. You won't be able to invest in this product, which comes to one of the other questions that came, is that this seems to have higher investment numbers. The reason being is to build a blended portfolio, we need to have a decent amount of capital in each one of the assets to make it worthwhile. If the 5 of us or 6 of us that are on this call all put in $100, and 4 of you joined us, and so we ended up having $1,000, and we took $1,000 and we invested $250 in the 4 different assets, it's a waste of time. Like, it doesn't make sense. So we have to get to a critical mass in all 4 of the asset classes to make it worthwhile, and that's why we've got the higher starting points. It is also a slightly more sophisticated investor, so we investment. So we wanted to be able to offer that. Why am I not saying, okay, the Goldman Sachs we discussed. How how do we view the future of money? Patricia, you're on the inner circle. I'll put it up on the inner circle again for you, and or I'll send it to you directly. Thanks for all the kind words, Brad. We are obviously always trying to work on the smaller investors, but it's about critical mass. I will say one thing though, even if you are interested, register your name on that platform, let us know and we'll keep in contact. I mean, I know that Chad's dream, Andrew's dream, my dream, Ken's dream, I'm sure Dr. Qureshi, I can't put that, I'm putting words in his mouth here, but all of our dream is to allow as many people to be able to participate in these quality assets. And if we could help people invest from $100, we would, but we have to make sure we have critical mass, basically. And again, it is sophisticated. Okay. No, the fee is not annual. It's a once-off fee. It's a transaction fee. So it's very important to understand the transaction fee. You know, the best analogy I can give you is if with Airbnb, I've got a house with Airbnb, and with COVID, I have no tenants. I'm not getting paid any rent. And Airbnb only make money when I make money. Whereas if the typical financial industry, they would charge me a 2% assets under management fee, and they'd be charging me, they were charging me a fee to rent my house, even though they're not renting my house or making me any income. And so it's a once-off transaction fee up front. It's not an ongoing cost, which is very, very important. I can't click on the polls. Don't worry about it, Dominic. The entry to the diversified is rather expensive in rand terms. Any chance it can be lower? Starting to notice a trend here. Stuart, thank you for the panel. I'm heading off. Thanks very much, Stuart. Thanks for joining. And how long is the investment at silver level? So again, we will be qualifying people. You can go to that launch page online.wealthmigrate/WDP-apply. We're going to be chatting to the wealth consultants and the team. And when we go live on the 9th of June, it will really be on a first come, first served basis. So highly recommend, there are caps and levels, and I highly recommend that you get your KYC, get your wallets funded, because you know that will be the way to be able to do it. Is the capital returned at the end of the period? Very much so. So you invest your capital now, you earn your return over the 5 years, and you get your capital plus your the potential upside at the end of the return. And the best part is it all goes back in your wallet, and you can reinvest it. So you can have compounding interest or compounding investing, and you're completely in control of your cash. Guys, it is 9:26 on my time. So I suggest we finish off with one final comment from the 5 of you. I'm really, really grateful for your time. Thank you for everyone that stayed online. There's hundreds of people still online, so clearly something that is of interest to people in these current times. Let's just go in the order that we started with, and just a final comment from your side, Dr. Qureshi, around what we've been discussing tonight and what it means to investors.
I think, thank you very, very much. I think it's a great pleasure and privilege to come here and to really talk about investment in the UK. I think it's a very safe investment. It is in a very stable market. And the other part that I'll say is that there is a moral responsibility of a society. So this is an investment that it will not only bring the commercial dividends, but this is something that we are doing for the humanity. So we feel very passionate about what we are doing now. And again, I say thank you very much to everybody for listening and for your questions. Thank you.
Excellent. Thank you, Dr. Qureshi. Really appreciate it. Chad, from your side, we've walked a long journey. You were one of the, I don't know if you want to call it brain boxes, but one of the brains trust is probably a better way of describing it, sitting at the back of the room discussing it. And it's quite exciting that, well, in less than 2 months, we've now brought it together. What do you think it means for people in terms of what you've been talking about with predictable income, but being able to diversify across assets?
Yeah, Scott, thanks again, and for everybody for your time. It's taken the longest time to get probably the best predictable income assets we could find and get them together. Love you to go and have a look, invite you to go and have a look at our website, and there are contact details. So anybody got questions, love to answer those. And Scott, hats off to you and the team, because at last I think there's something that's really, really tangible, well worth investing in, and something my kids can do now, which I'm super excited. Thank you.
Awesome, thank you very much. Andrew, from your perspective, 27 years in the financial industry. I laughed with you 2 weekends ago where you and Chad and I were on a webinar, and Ann Wilson, who's someone that helps people invest in financial markets, had you dancing to some music, and I said, I bet you didn't do that in Switzerland. The world is changing, and in the old days it was a bunch of people walking around in suits only helping very elite families, and now we're talking about these products with everybody because they got access to technology. Did you ever expect to see this happen in your lifetime, and how does it make you feel that people can now get access to this?
Yeah, it's very liberating, and I think one of the things that I take away from listening to this product and listening to the way things are moving is that we're taking the guesswork out of investing to a large degree, in terms of if it's contracted, you see what it is, what's on the box is inside the box. I've seen so many sad stories where you get to a point in time where you need to realize your investment and it's simply not what it said it was going to be. And then it's too late. We come back to that issue of time. So I think time is something we can all control. I listen very carefully I'm humbled when I listen to people with families who want to entrust, like Chad, intergenerational wealth. He's building that platform for his kids to educate them, to take them on that journey, and to go beyond what is normal, go beyond the norm. So I think the blend of what Ken has put together, what Cashbox has put together, and what you guys have put together, we've made it simple and we've made it accessible, and it's actually very, very obvious, certainly to the clients that I'll be presenting this to, that this is a great solution to form part of that core, the core that you don't mess with.
Excellent. Hank, from when I met Jim Rogers back in 2014, he said, Scott, listen, the 19th century was all about the British Empire, the 20th century was all about America, and the 21st century is all about China, so much so that he moved his entire family and lives in the East now. And I literally went to China that next year, and I just was blown away by the opportunity, and I've been excited about it ever since. The challenge is if you don't speak Mandarin and don't understand the culture, you have like zero chance of success in China. Ask Uber. And the point being is that I'm really grateful that through the partnership with yourself, people get access to what's happening in China, and they can partner with you on the ground. But equally, we can take the knowledge that we're learning off you in China, because you're ahead of the trend, and figure out how to put it into the world. And so I just wanted to say I'm really grateful for you on that. What's your final comment on with people using their phones so much, paying for everything online? How soon is it going to be till all investing is online as well?
Thank you, Scott. Yes, I think the Chinese people are definitely not strange to using their smartphone to do investment online. I think they've done it with the stocks, both domestic markets and the international market. So, and then also purchasing real estate on their smartphone. I read an article on Wall Street Journal. Somebody just in China, in Beijing, just bought a apartment in Thailand because he felt he went to Thailand and then he liked the place, so he just purchased an apartment in Thailand. So definitely the technology is transforming the investment, the ways that Chinese people do investment. And I think we came here, we got to China very early, and then we were able to pivot our strategy and then to build a platform going forward. And then so I think this year is our 4th year here in China, and then we've accumulated a lot of experience and knowledge, and then we believe this is going to be have another strong year going forward.
Awesome. No, thanks very much, Hank. And my final comment to Ken, who was another one of the Brains Trust that was sitting at the back of the room with Chad and Andrew and Brendan Brown and etc. around this whole product. Two questions for you, Ken. One is how's it feel to actually see it in existence? You can actually see the brochures and stuff on the up on the screen. And secondly, what does this mean in terms of technology, where you can take an idea and you can turn it into reality and solve people's problems in basically less than 2 months? What does it mean to the world?
Yeah, I mean, what's fantastic is you've listened to an expert in their area in each circumstance here. What's really interesting is the platform holds all these assets irrespective. So if you want to, you can invest in any of these assets on their own. There is nothing untoward or difficult to understand about grouping these assets into a product like this to give you some diversification. And what it means is that as we move forward, we're going to have more and more access to investments that otherwise ordinary investors would just never have had exposure to. So that's what's that's what's pulling us forward here. That's what's really exciting about it. And I just wanted to make one final comment. Is Brad asked you a question about? He said, could you potentially do a structure in family, multifamily, possibly in the States? Now, our sales consultants are starting to become a demand discovery team for us. They're actually coming back and saying, actually, the clients are asking us about this type of asset. Now, what's going to happen is these assets are going to prove on the platform, and ultimately you will end up in a situation where it would make sense for us to say, actually, we're going to group a set of these assets together, which would be the right thing to do. So, it gives us that opportunity, and that's, very grateful for the contribution of the other guys into this.
Awesome. Well, listen, thank you very much to everyone. I really, really appreciate the panelists' time. I'll probably never be able to get a webinar with you ever again when I ask for an hour of your time, and it ends up taking 2.5 hours. But hopefully you've seen that by the interactivity of people and, still a couple of hundred people online, that, this is clearly something that people are interested in. So I'm really, really grateful for your time. To those of you who've been online and asked all the questions and been part of the energy, I'm really grateful to you, basically. And, most people won't remember the Netscape moment. They won't remember when they first had that browser and how the whole internet changed for them. Some of you might remember when you first got your first smartphone and the world just started to open up for you. And maybe tonight you might look back. We've often looked and spoken about building the Amazon of real estate. And, we're starting to widen that net now and say, well, why not the Amazon of private wealth? And hopefully tonight, just maybe, we might have given you a little inkling into the future of where we see the world going and how you get to participate in where that world's going. So thank you very much to everyone's time. That is all from us tonight. Please reach out to the team, reach out to any of our partners. All their information will be on the platform. We will share it. This is not about our intelligence, it's about their intelligence. And I remind you that there's 3 things that you need in this current time. You need the right information, you need the right partners, and you need to diversify. And using technology, I believe now you can do it safely and simply. Good night, and thank you very much. Cheers.
Thanks very much.
Thank you. Thank you very much, everybody.
Which we will return to